Hello, Alexander, Max, Lukman. Thanks so much. All you guys have asked great questions in the past. Looking forward to it. Let me see, Twitter. You guys can hear me right. Okay, good. I think I'm gonna have to turn on the air in here. Does it sound good now? Now that I have my earpods? Okay. Okay, 1 second while I get some water. See, so the questions are in. How did I handle a month like we had in July? It's going to be a very important question. The short clips must be doing well. It's all my feed is giving me. Hopefully, I have great help with the short clips. Okay, I think we're going to start. I'm kind of amazed as to who watches these AMAs. I was in Italy a month ago, spending the weekend in Portofino with a dear friend of mine. And I ended up meeting the owner of this Italian business, and he had watched some of my videos. I was shocked, actually. because this is very nichey stuff. This is like, investment brainiac on the nerd patrol shit, but really, I'm amazed. And again, thank you, because the reason why I do it is to add value, because we have a content strategy and all of that stuff. But um, it's crazy how smart the feedback is, and we use it, to improve. That's the beauty and value of a content strategy, right? Um, I don't have an initial thing to share, like I usually do, because we've talked a lot about some of our thinking when it comes to investing, development, time management, even. Um, Even I've had talks before about nutrition, exercise, and recovery, and the importance of that for investing. Um, but really, I haven't said it all. There's a lot of things that I can't share publicly in what we do. So I'm going to dig into the questions almost immediately to what people entered, and as you have more questions, make sure you write it on the Zoom. Um, why is it not playing here? Oh, okay. Okay. So let's start. Let me just make sure that this is live. All right. The questions were really good. Um, I'll start with a question from Shekar. Um, Shekar asks, I have started reading Roger Ames' The Art of War and Treason and Efficacy, and both are slightly difficult to read. Any books exploring same topics and light read for the Chinese way of seeing things and the world? It's a good question, and it's my fault for I guess assigning these, but let me do it this way. So I'll share my screen with you guys to kind of explain what is happening here. Okay, so uh, let me see if you can see that. Okay, is my screen sharing? Yes, sir, it is. All right. Okay. So the books that Shikar is talking about are this one. So Roger Ames, Art of War, uh, which, in my opinion, is the definitive version of The Art of War. Now, for those that have not read The Art of War, you probably will read the American version, the Brazilian version, the French version, which are all the translations of this book, which, in my opinion, are all flawed translations. And Roger particularly solved the problem of translating The Art of War, which is not only understanding it from the Chinese point of view, but also understanding it from the Chinese point of view and context in which it was written almost a couple thousand years ago. All right, very important to understand the contextual and historical understanding of that book. And in it, he discovers some strategic concepts that, frankly, haven't been understood by the West, whether the French, uh, uh, the Americans, the Europeans, but interestingly, the Israelis understood it, and then the Russians as well. But that's because the Russians, for a couple centuries, got almost killed by Genghis Khan and the Mongolians that were using art of war tactics. If you haven't read the book on Genghis Khan's favorite general, Subudai the Valiant, there's a chapter on that, how a Russian military strategy was influenced by the what they learned from fighting the Mongols. Um, anyways, the other book that Shikar is talking about is also this one, which I'm interested in seeing if it's picked up here. Maybe, there it is, which is Treaties on Efficacy. And interestingly, Roger Ames' Art of War and Treaties on Efficacy share the same intellectual lineage, meaning François Julien, which is this guy, okay, actually came up with his concepts and treaties on efficacy because he had read Roger's book on the art of war. Okay. And what he realized is that in Roger's book, there's a concept called shi. It's spelled SH', which means propensity born of disposition, which is an academic way of saying that certain situations have more embedded power than in others. Right? So, for example, if you look at what's an example of this? The classic example in the art of war is the crossbow, right? The crossbow is, despite its size, can shoot an arrow close to hundreds of meters. And the propensity and the power within that can cause a lot of damage. Well, certain situations have a lot of shi in it, that it has a lot of power embedded in the situation. And the art of war by Sun Tzu was all about using shi as a strategic tool to defeat an enemy. Now, what does that sound like? Well, certain stocks and businesses have a lot more embedded power within them because of their own internal power, because of the environment, because of tailwinds pushing them than others. I mean, we've seen that over time, right? So Julian picked up on this strategic concept and asked the question, wait a second, why is it that we don't have that concept in the West? By the way, to be fair, we didn't have words for that concept in the West really until the 1900s, which is interesting for a whole bunch of other reasons. And what Julian saw was that the West, Europe mostly, also because of Aristotle, because the father of Western thought is really Aristotle, which, by the way, Greek guy 2,000 years ago, has more influence on our way of thinking than probably any other philosopher. He realized that the West was very means and ends driven, meaning you have an end, you have an objective, and you have the means to accomplish the objective. And in the West, we really focus on this objective that we have and then what the resources that we have to accomplish the objective. And irrespective of the environment. Whereas in the East, the Chinese think not in terms of means and ends, but think in terms of conditions and consequences, meaning it's all about the environment. If you want to cross the Atlantic Ocean, it's better if you have the wind at your back. It's better if the weather's good. It's better if you're not facing very large octopus or killer whales that want to crush your boat, right? The environment matters. And all of the problems of Western and Eastern philosophy come to that realization, which sounds simple, by the way, but believe me, it's not. But again, what does it sound like? Value investing, means and ends. You buy a cheap stock, independent of the environment. Who cares? It's a recession, it doesn't matter. You got to buy when it's cheap because as long as you hold fast enough, you'll accomplish the objective, the end of making money. But whereas if you're looking at conditions and consequences, you're like, the environment matters. Why should I buy a cheap stock when the economy is bad? Geopolitics is bad. There's war, there's rising rates and all that stuff, and the stock is going down. So again, both this book, if you really understand it, is going to show you why it's not just means and ends that matter. It's not just conditions and consequences that matter, but it's to use both approaches, right? If I want to surf a wave and my means are my surfboard and my end is to surf the wave, well, guess what? It's going to matter if the conditions and consequences are good. If I want to surf a wave in Miami, it's very different than surfing a wave in Hawaii, right? These things matter. Anyways, so that's what these two books try to explain. One of them is really about strategy and using means and ends and conditions and consequences to defeat an enemy, which is the art of war. And the second is the one that explains this philosophy, right? By the way, it's my favorite type of philosophy. It is possible to have a philosophical advantage in in investing or life, and it's very important to read. But my favorite type of philosophy is comparative philosophy. I want to compare how um, the Chinese think about life, war, happiness, religion, how the West thinks about life, war, happiness, religion, how the Buddhists think about it, how the Jews think about it, how literally everybody. And I want to pick the best from everything and apply it and make it my own for that. But to answer your question, because those books are dense, because first of all, Roger, as much as I love him, is an academic. So his writing is very academic. Julian is not only an academic, but he's a French academic. And Treatise on Efficacy was translated by another academic. So the writing is dense, but really it's worth reading and it's worth understanding. It takes a while, though, and I understand that, but only do so if you want a competitive advantage. Having said that, the intellectual lineage continues, and it continues with this guy. So it so happens that Joshua Cooper Ramo, uh, who's on the board of Starbucks, on the board of FedEx, uh, had, oh wow, he's writing another book. I did not know that. We're going to have to get in touch. Um, he wrote two books, and it's in reading these two books that I discovered Rogers' work and then Julian's work. Because interestingly, I discovered it not by the source first. First, I studied Cooper Ramo, then I discovered Julian, and then I discovered Roger. But really, you should read it Roger first, then Julian, then Cooper Ramo. But having said that, I like the way that what is this weird ad? I like the way that I discovered and then because I traced the intellectual lineage. Okay, so this book was written after 2008, and it talks about how because the world is more interconnected now, not only with information systems like the internet, but also with logistical systems, travel systems, geopolitical systems, even that because of those interconnections, more and more things are happening that we've never seen before, that we've never thought about it, right? And he uses a bunch of concepts from both the art of war, systems thinking, complexity, and then treatise on efficacy by Julian to help you understand what's happened. By the way, the book is dated. Since then, I would say that a few things have happened that have changed. Uh, but I think it's still worth um, um, very much studying. And you know, I could go through monstrous amounts of quotes to help you understand what's happened, but he actually has also a lot of new ways of seeing what's happened geopolitically that are going to make you go, maybe history doesn't really understand what's happened here. By the way, his second book that you have to read is this one. It's called The Seventh Sense, which is he talks about um, the five senses, touch, sight, and so on. He talks about Nietzsche's sixth sense, which is a sense of history, and then he talks about a seventh sense, which is a sense of networks and understanding. There's a lot of powerful insights in this using these things. So, Shakar, these are the two books that I would read to understand those two works. But really, believe me, stick to trying to understand the source books. They're very powerful. If you're looking for Art of War, um, uh, by Ames, the chapters to read are the first, where he explains um, the historical understanding and gives you the historical context, and where this part, for example, the analysis of Sun Tzu, the art of warfare, wisdom, and some of the stuff that he talks about are so good and apply so much to business that they are a must read. By the way, it's not unusual to find the art of war inside every successful institution that we've studied, actually. So if you look at the Patriots, Bill Belichick quotes the art of war all the time. And in fact, if you study his father's book, which is Football Scouting Methods, Steve Belichick, it's literally the application of the art of war, but in studying a competing football team, which is kind of scary if you're a player to know that you've got guys like Steve Belichick and Bill Belichick studying your play and ways of taking you down. That's not comforting, but very powerful. And you'll find, um, like, for example, the classical Chinese worldview, the uncommon assumptions. This is very powerful ways of seeing stuff, and worth the read. Okay, I hope that was a good explanation. Okay, some good questions coming in. All right, I'll answer those as we go. Okay. All right, a question from Andrew Gabriel. Um, hmm. What are your latest insights on how the best institutional investors are actually using LLMs to build repeatable research and decision loops rather than just summarize information? Which models and tools are proving most useful? How are leading teams dividing work between human judgment and agents? And what does the strongest end-to-end workflow look like from a source ingestion and variant perception formation through portfolio decision monitoring and postmortem? More importantly, where do you see a genuine, durable edge emerging versus workflows that will quickly become commoditized? And what failure modes are the most sophisticated users still underestimating? Great question. So, without breaking any confidences, because I tend to be brought in to a lot of very smart hedge funds internal workings because I grew up with these guys and we work on developing advantages together, tools together, people together, and investing is very much a team sport, at least the way we practice it, but also the way we believe the best practice it. And you cannot do what we do without a network of other smart investors and PMs. So I can't share what other people are doing. But here are a few things that will help you out. Um, you have to watch a podcast that Joe O'Donnell, the CEO of Cannery, did with Brett of Fundamental Edge. You can find it on YouTube. It was excellent. And we've used or tried a lot of these AI tools. I'm telling you, the just as a um, step back a second. So there's an amazing book called On Flexibility by the head of the IDF Special Concepts Division. And one of the pieces of advice that he gives in the book is always spend time with the arms dealers. Because if you're dealing with an enemy, odds are he's buying weapons from somebody. So it's your job to really spend time with these arms dealers and understand what these weapons are that might be used against you. That way you know how to defend against them or how do you use those weapons when you go on offense yourself. So these AI weapons, uh, even if we're not going to be using them, we have to spend time on these things. There's some of them that we think are excellent, okay? But others that we're like, yeah, no, this is going to be a feature somewhere, and there's no business nor moat there. But here's your question is very thorough, okay? And you can tell that it's a very intelligent and well thought out question. But you have a problem if this is the question you're trying to answer. And the reason why is, first, you have a competitive problem. If you think that you're going to be able to replicate what Citadel, Balyasny, Tudor, Moore, or even Bluecrest, or any of these other pods are developing, you're never going to be able to. Okay? They're too smart, too well resourced, too experienced, and these tools that they're developing is massive. And not only that, you see, to do AI well, you need three things. You need algorithms, you need data, and you need computing power. These guys not only have the algo, not only the computing power, but they have the data. They have hundreds of thousands of reps that they can run their models through, right? They have data sets that they can use that are very powerful. They have research internally and externally that they can use that's very, very powerful. Can you replicate all of that? Okay. And the second question should be, because you asked the right question, which is, how do you, what are these people doing, and is it going to be an edge, and so on. But no one really is asking the question, are these tools, by using them, impacting portfolio management, team selection, training, leadership, development, compensation structures? If you're developing this great tool, and what used to take you a week, you only take a day, why am I paying you? Right? These tools are going to be commoditized. So how is this going to impact compensation structure? How is it going to impact your patients? Because if if under normal times, an analyst, it takes them a week to understand the consensus point of view. Now it's going to take them less than 4 hours to understand how the consensus is thinking about an idea, right? But what are you going to do with the rest of the time? Is that going to impact your patients? So interestingly, we've seen this happen in other fields. So online poker, most online poker players are playing multiple tables at a time, right? So the number of decisions they're making is much more rapid. But interestingly, their discipline can break down when they go play live and the game slows down dramatically, right? And I think there's going to be a similar problem because you can come up to speed very fast on an idea with AI. But guess what? It takes the business and the stock a while for it to work. It might take very little time to reflect a piece of information, but you have guys that have 3 to 5 year point of views that are doing 1 weeks of work on an idea for a 3 to 5 year point of view. There's some things they're going to have to reconcile here. Then you have another problem, which is, do you have the right contextual, um, I would say, historical context and philosophical knowledge to be able to apply these tools well? The foundation of a process is usually a philosophy. Is value investing, for example, plus artificial intelligence, does it work together? Does it? Are we going to need other philosophies to be able to figure out? You know, by the way, there's a large quant fund that I'm close with, and I see them sometimes at poker games, and they're always laughing about fundamental guys using these AI tools. And the reason why is they're like, we were using these tools in the 90s, right? People forget, but quantitative tools, not the version that we have today, by the way, because today they are really souped up, were being used by quant funds and Renaissance in the early 90s. Okay. You have to read um, the predictors, you have to read formula, you have to read More Money Than God, the chapter on Renaissance technologies, and you'll realize they're kind of using the stuff back then. The fundamental guys are only using this stuff now, right? And by the way, some of the ways that we're using it, it's unclear if these things are suitable for it. By the way, so I mentioned this before, but the first place that I saw these tools was 1990 when I started playing backgammon. Gerard Tesoro at IBM had developed a tool called TD Gammon. I actually have the book that my mentor wrote about um, TD Gammon, which was Learning from the Machine by Bill Roberti. Bill, did I get that title right? I know you watched this. And it's interesting because the first neural nets that were commercial were developed to play backgammon. One of them was called Jellyfish, right? Then Snowy. And now we have XG, which is an incredible backgammon tool. And it's really interesting how that improved the games of players, but in many ways it ruined the game because a lot of people realized that backgammon, there was not a lot of mystical and luck stuff with it. When you put your position and your play and one of the backgammon tools, it showed how much of a fucking idiot you were, right? You were like, oh, it's not I had bad luck. I made a really bad decision, right? So I think we're going to go through a little bit of that. Interestingly, the same thing happened when AI tools started proliferating in the intelligence world. Intelligence systems and people started making mistakes and realizing that, hey, you had SIGINT, which is signal intelligence, and over relying on signal intelligence could be a mistake because our enemies realized that we were using these tools and they made sure that what they were doing could not be quantified, right? So human intelligence started mattering more, right? So you have to think about before you use these tools, when they've been implemented in other fields, what are the problems that people have faced in those fields? Not just let's go deep and doing it and making mistakes. You kind of need to be careful because you're implementing new ways of thinking, new weapons, new processes even. This could have a retroactive impact on your culture and on your business, frankly. Are these tools, for example, making the structural fragility of hedge funds Bigger or smaller? Interesting to think about. But last, there's the where's the beef question. Okay. Are these tools improving your performance? Are these tools making you money? Okay. So technology is amazing because it lowers your cost and extends your reach. And AI should do that very fast, both financial and really temporal cost. We have an idea generation process that we run on a monthly and quarterly basis. We cut down the time to do so by maybe 75% using AI. Okay. So it lowers our temporal costs and financial costs because my time is valuable. So is the ones of my friends and allies and colleagues. But is it improving our performance? Okay. And by the way, uh, talk about July of 2026. Imagine all those guys that are using these AI tools. Did these AI tools stop them from going through a drawdown? Okay. And by the way, I have a very dear friend of mine who doesn't use these AI tools, who, in my opinion, is probably, top five best long short managers alive today. And we were talking early July. He doesn't use these tools, but he's like, hey, we're sitting here. It's peak crowdedness, peak gross exposure, peak net exposure, peak concentration, and yet we're walking into July, which is seasonally a weak period for momentum stocks, and we have all these narrative and macro problems to boot. I'm going to degross, right? He didn't use AI for that, yet he degrossed and didn't get smacked around like a lot of guys got smacked around in July, right? So, did these AI tools stop you from getting killed in July? Interesting, right? Okay. I hope I answered that question. By the way, so in the 90s, when all these professional backgammon players were using these AI tools to get better at backgammon, they were playing against each other and making no money. Whereas me and a group of guys were playing these crazy Italian and Greek billionaires for money and making a lot of money. Again, it's like I think I've shared this anecdote before, which is the story of the fisherman that walks into a fishing store and he looks behind the counter. And by the way, I stole this from either Charlie or Warren. And he looks behind the counter and he sees all this crazy lures and baits. And it's got squiggly lines. There's one that spins. Some of them are purple, the other are blue, the other are green. And he's like, wow. And he asked the old timer behind the counter, he goes, I'm sorry, do fish go for these lures? And the old timer goes, I don't sell to fish. Right. And I think these tools are really alluring. Okay. And by the way, I've seen some amazing ones, truly. I'm like, yep, I would want that. One of my youngest mentees and my first intern actually have developed tools. And I'm like, wow, phenomenal, incredible, incredible. And in fact, he and I are studying a theme together and he cracked open the theme and what to track on it using these tools. And frankly, I hadn't gotten there at all, but he did. God bless him. Um, but still, the jury's out as to whether it's going to be improving performance for a lot of people. I hope I didn't deflate your bubble. By the way, just like I used to tell my wife, everything that I say has a lifetime of 5 minutes. You can't use this against me in the future when I've changed my mind. I'm like, nope, got to use them. But for now, we know enough about their weaknesses. We know enough about their costs. We know enough about how they should be used and what situations to be a little bit skeptical. But we'll get there. Okay. Take on Molawa says, what does lead generation entail for a PM running their own fund? Is it content creation, pitching LPs, networking, and how to balance that with managing the portfolio day to day? Thanks, Alix. So it's a good question. So, um, so first, in the investment business, uh, activities tend to be in their own verticals and separated. And so, for example, you might have a marketing function where you're meeting with LPs that are going to invest in your business. And you have the performance function, which is you analysts and looking to take down big scores in the investment business, right? There's a flaw in that approach. And the flaw is a time management issue. Both are super, super, super time consuming. By the way, to get 10 investors, you probably need to meet 200 potential investors. It is that low in terms of a success rate in the investment business. So just keep that in mind. That can be a very low return on time activity, right? And the performance side, it's extremely time consuming. You have a team to manage, you have ideas to generate, you have processes to manage, you have things to read. It's no wonder why most portfolio managers develop attention deficit disorders, right? There's a lot to cover here. By the way, one of the sad things in our business is meeting old portfolio managers that no longer can focus on anything. They have the focus of a goldfish, where you talk to them about X, and then 10 seconds later they're somewhere else, and it's like, oh, this is what I could become if I'm not careful. So you have to be very, very careful. But what I would say is, you want your lead generation to come in combination with both marketing and performance. So how do you do that? So let's say that we're looking at transportation. Okay. Transportation's having a bit of a moment right now. Well, in our research, right, I'm asking my team and in my network, who are the richest people that know transportation really well, that own private companies in transportation, that are private equity funds in transportation, and let's go and raise money from those guys as well. Because as we're talking to them about what's going on in the industry, by the way, all within compliance rules and everything, we're also going to be like, hey, we want you to be an investor in our fund, right? We want you to invest in our business. And by combining those two things, if that guy then says no, right, at least it's not a wasted activity, and we're able to get a performance thing out of him. It could be an introduction to a management team. It could be a piece of research to read. So I think in terms of lead generation, it really matters whether you have separate marketing functions and performance functions or combined ones. We like a mix of things. There are people we never talk to about business. We just want them to invest. There are people that we want them to invest, and we want to share ideas with them, and so on and so forth. So lead generation tends to be, for us, what gives us a competitive advantage. Okay, so everybody has different advantages, a different moat even, and you have to make sure that you're constantly feeding your competitive advantage and your moat. I have a moat. It's about, let's say, 10 things. 3 to 5 of them are maybe 80% of the value, and the others are smaller. By the way, I find that moats, whether by young or my peers or older people, are very misunderstood still. People haven't really deeply thought about moats or studied all the different ways. Have you read Seven Powers? Have you read Competition Demystified? Have you read The Economics of Competitive Strategy? Have you read um, uh, Michael Porter's work? Have you read uh, uh, books on competition and the NFL and the military and sports and intelligence? You need to read all that stuff to have these analogies to understand and how to pick up on when a company is doing something that gives it a competitive advantage, right? Or when an individual is doing something that gives a competitive advantage, and how to increase your moat to give you a competitive advantage. By the way, moats, competitive advantages, edges, people tend to use it all the same, but sometimes they're very different. But anyways, so lead gen for me looks like great ideas. Okay. I always want to get great ideas. Then a second is smart talent, right? I want to hire great talent. So I love when somebody says, hey, can you meet this guy? I think he'd make a great analyst for you. Well, let's go. Um, I want rich, smart investors that to invest in my fund. So that's lead generation. Um, Jeremy Giffen, who's a buddy of mine, has a thing called $1 billion PDFs. I love when somebody sends me a piece of writing that not only changes the way I think, it has a paradigm shift on me and can improve my performance. There are things like, for example, if you read Investing in the Unknown and Unknowable by Richard Zeckhauser, that changes things. If you read Charlie Ellis's The Loser's Game, that'll change your mind. If you read anything that Michael Mauboussin has ever written, that will change and expand your mind. And by the way, in our content strategy, we try to design memos to our partners that do that. And I believe we have actually, where when we share something, and we shared a memo on our stock selection criteria, for example, and it was funny because we sent it to like 2,000 people, but the people that were replying back were literally the 20 best investors that we know. And they were like, hey, this is good. Don't share it anymore. But by the way, have you thought about this and that? And it improved, right? What we were doing. The last thing I would add for this, by the way, on lead generation is you have to design your lead generation so that it's an inbound phone call and not necessarily an outbound phone call. If you have to call out to get ideas a lot of the times, it's not as powerful as somebody calling you and being like, hey, have you looked at this? Or a friend of yours like, dude, I'm sitting on ideas, the best idea I've worked on last 5 years. Can I pitch it to you? That's much more powerful. Or somebody that calls you and is like, hey, can you meet so and so? Where one of my mentors, for example, Peter Kaufman, called me and said, hey, you need to mentor this other kid. And just mentoring this other kid who happens to be a highly precocious, was probably born 50 years old, very mature thinker. Just by teaching him stuff, it's expanded my way of thinking about stuff, right? And I would have never had that had my mentor not called me and said, hey, go mentor this guy, right? So the inbound phone call matter. Now, how do you create inbound, what we call being a KCI magnet, right? Be a magnet for knowledge, contacts, and ideas, right? KCI, how do you get it? Well, first, you have to give it out. By the way, one of the greatest things for lead generation is actually a content strategy, right? Okay. Okay, Rabbi Jacob. By the way, it's a very famous French movie called Rabbi Jacob. It's very funny. By Louis, avec Louis de Finesse. He says, when you've been in a name where the numbers kept coming in fine and the stop kept grinding down anyway, what was the tell that it was a D rate rather than noise? And how long did you give it before you cut? Um, the tell that it was a D rating is often a few things. One, if that name is D rating, odds are other names in the industry are also D rating, right? So you're not only looking for the performance of your name, but what's going on the sector of the name. Are those names derating too? The second tell is narratives. There's not enough of a focus on narrative analysis in the investment business. Um, okay, let's share a little bit of the kung fu here. Okay, so one of the things you should do is called the research compilation. Download, if you have access to, the last 2 years of research on an idea. Start with the one from the piece from 2 years ago, and then chronologically read this research report. Generally, you only have to read the first page or even the title. But by doing that, you'll see how the Wall Street community, what kind of questions and what the narrative is on the idea as it goes from 2 years ago to 23 months ago, 22 months ago, on and on and on and on till today. And then by doing that, and also one thing that's very powerful is either on Substack or Twitter or Value Investors Club, seeing what people are saying about the idea, and then more or less understanding, hey, what are the bullish narratives on the idea? What are the bearish narratives on the idea? And understanding how that narrative is either going down or going up, right? You need to do that because the fundamental work is great. Congratulations. Yes, everybody does that. Okay. But have you taken a time to understand the narrative? Pre 2008, narratives were important. Today, post 2008, and this market structure with social media, Twitter, and the change in market structure, narratives can take apart a company in a quarter, the stock, and then in a month, it comes back, right? So you have to understand the narrative. By the way, understanding the narrative is a bit different than understanding the market perception. They're related, okay? And then third, it will help you understand your variant perception on the idea. So you know, um, we look at that. Then another thing that we try to understand is the soft behavioral stuff. So sometimes an idea is re-rating because the idea could be in a basket, right? Today, this new phenomenon of the last 6, 7 years, which is, when a long short manager is lazy and he's long X company, he doesn't want to find shorts for it because let's be frank, everybody's gotten lazy on the short side. Thank God, by the way, because we love the short side. There's nothing better competitively to me than the smartest people in the world that I know that are no longer short selling. Nothing I love to hear more. Um, which is unbelievable to me. And everybody's gotten lazy on the short side. So what that guy that's long that asset, he calls his prime and he says, hey, give me a basket of names, right? That are factor or beta or market correlated with these names. And that way it kind of hedges out. But when my catalyst happens, that factor should be flat and my stock should be up and I'll earn that spread. Well, guess what? If one of the names that you're long is in this basket, okay, it could trade in ways and you're like, what the fuck is going on? I don't understand why the stock is moving this way. So you have to understand if that a behavioral dynamic might be happening in the name. By the way, very often when a name is re-rating, there are also big competitive dynamics that could be happening. It could be a regulatory issue, or there's a change in regulation. It could be interest rates. It could be currency moves. I'm sure you guys are watching what's happening to the Japanese yen in the last month, but it could be that. It could be, these are all things that you have to track. But by the way, I think before we decide to cut because of things that we're tracking, there's a couple things that we do that I think is important. One, we have mechanical rules. I never want to lose more than 100 bips in any one name. Okay. And if I'm down 50 bips on a position, we re-underwrite it. Is that we're missing something. Generally, we do timing work, we do behavioral work, we do fundamental work, we do thematic work. Why is it down? We should have gotten all of that. So if we're down, we really want to understand what's actually happening. But we might cut the position, okay, because clearly we're losing money. There's something that we don't understand, right? And by the way, we rarely average down as a firm. Averaging down is only a recent core competency for us. Historically, we've been terrible at it. It's only recently that we've learned how to do it. And then historically, we've actually been better at averaging up, meaning a stock is up. As an example, we think the stock is worth 60, it's trading at 30, but something just happened, earnings that show it should go to 40, that it goes to 40, excuse me, but we think it's worth 60. We're willing to buy more of it there. Up rather than down, which is the opposite of what most value guys do, by the way. A lot of value guys have a hard time buying something after it's gone up. What's happening there is they don't realize is they're anchoring to a past stock price in their minds. And also, because the stock was cheaper below and they anchor to valuation, they have a hard time paying up. By the way, William O'Neill's book, which in my opinion is a criminally underread book in the investment business. It's called How to Make Money in Stocks. And I think it's paramount to read. And in it, he makes a point that I've never seen anywhere, which is that in his studies of traders, only 2% of traders and investors were able to buy a stock after it made a new high, right? And his argument is 2%, by the way. His argument is if you think about the best stocks that ever been, they're always making new highs. Yeah, invariably they go through drawdowns, but the best stocks are always making new highs. But it's only 2% of traders are able to pay up for them. By the way, I think I understand the can slim methodology is very well worth understanding. And I think I know why people don't like this book in the institutional hedge fund investing community. I think it's because it's associated with the Investor Business Daily, which I read and I love. But a lot of guys are like, you read Investor Business Daily, you read it. What do you get out of that? I'm like, it's excellent. But they associate it with retail trading and retail accounts, and they're a bit snobs, in my opinion. Very powerful book to read, and well worth it. But so it have mechanical cuts. By the way, if you're an American and you own a stock, you have a 4% position, it goes down 20%, you're out 80 bips. Nothing is happening in the stock for the next couple of months. The company's not reporting. You actually should sell the position, book that loss, that short-term loss, and revisit 30 days later to buy it back so that you can book that short-term loss against other losses that you might have. And that's one way of increasing the tax efficiency. And also, the majority of somebody did a study once. I think it was 50% of the time, the stock was moving on macro geopolitical news. 35% of the time, it was moving on sector news. And 25% of the time, it was moving because of its own fundamental reasons. Are you good at understanding what that 25% is? Can you own a stock for that 25%? These are all timeline things that you have to do. By the way, um, um, people hate in the investment business, they'd hate these two words. Um, and a friend of mine calls it technical analysis, which is these two words, the mistress that, or the lover that every PM doesn't want to talk about. And especially allocators, the technical analysis, charts, mumbo jumbo, and all this. But generally, technical analysis can prevent you from making some really, really silly mistakes. Um, and we have a stock last year that we were long, and the fundamentals were going like this. Okay. And yet the chart was flat. And despite the fundamentals increasing, the chart wasn't showing that the market or the other holders thought that the stock should go up. And that perplexed us, right? Because wait a second, they just reported a quarter, everything is fantastic, yet the stock's not going up. We're missing something. Okay. Then the stock starts to dip. And by the way, this is a very crowded names. A lot of marquee hedge funds were long this thing. Okay. And yet when we called around, no one understands why the stock is going down. Okay. Well, we immediately got out. Okay. Because when a stock is moving counter to what you think it should be, and you cannot explain why, there's a very powerful thing happening that you don't understand. Right? When something doesn't make sense, yet is still happening, it makes a lot of sense. You just don't have the worldview or the conceptual scheme to understand what's actually happening. Okay? And we got out and saved a 50% drawdown in the name. And despite some guys that we know that lost a lot of money on this thing, because they were like, fundamentals are great, I'm just going to average down. Then it would go down. Then they average down. Then it would go down. They would average, and I mean, literally, until one guy threw in the towel, and interestingly, right before I started going back up again. So I think it's important to really understand what the drivers of a name are, and if you don't understand, just don't play. Okay. Jackson asks, inspired by Michael Mauboussin, More Than You Know, page 84, 2 questions. In your investment process, how do you distinguish trained intuition from ordinary day-to-day emotional variance? And did you learn to trust yourself, train your pattern recognition only through actual experiencing big losses and big winners, or did you do something else with your team? Great question. So we not only train our pattern recognition through our winners and losers, right? You have to study both your big winners and do postmortems on those. And you have to study your big losers and do postmortem on those. And we have a process for doing both. By the way, it's not unusual to do a postmortem on a winner and see that you got lucky. Okay. We actually like that. By the way, I don't recommend these processes for everybody. If your confidence, if you have a hard time being confident about your process and you can get shaken, don't learn from your mistakes. Just keep going. Okay, because I've seen people get shaken out or lose their confidence when you show them that what they did had nothing to do with why they made money. On the contrary, they made a ton of mistakes, or the reason why they're losing money is they're just not that good, right? So you have to be careful, and you have to have a healthy ego to not only take the feedback and be like, yeah, that hurt, but guess what? I can bounce back, right? Um, and okay, so that's the first thing that you have to do. But the second thing that you have to do, okay, um, is study the successes and failures of others. There will be a lot of pattern recognition. You know, I heard Eddie Lampert one day talk about how he had uh, uh, reverse engineered every investment Warren Buffett had made in the Buffett partnership and then at Berkshire Hathaway, right? Have you done that? You know, have you studied the 13F of one hedge fund manager going back 25 years? You know, do you understand the power zone of a money manager that you respect? You know, I have a lot of respect for Ackman, for example. Do you understand his power zone? Do you understand Steve Mandel's power zone? Do you understand Lee Ainsley's power zone? Do you understand um, Philip Lafont's power zone? You know, and are you able to understand, you know, even sometimes better than they do, the ideas that they really are good at versus the ideas that they're bad at, right? So we study patterns of success and patterns of failure uh, in the investment business, but we also do it in the military and intelligence and sports because those analogies, those examples also matter to what we do here in the investing. They're good analogies for us. Um, okay, so talk about Michael Mauboussin when it comes to intuition. I've talked about this before. 14 years ago, uh, I'm buddies with Tim Ferriss and Josh Waitzkin, and I wanted them to meet Michael Mauboussin. So Tim, Josh, Michael, and I went to have lunch. And during the lunch, Josh and Michael started getting into a discussion about intuition. And Josh, his belief was that it was important to trust your intuition when it came to investing, right? Because in his experience, he saw that in both martial arts and in chess, intuition sometimes knew the answer before his actual mind actually did. And Moby, Michael Mauboussin said, hey, you have to be careful trusting your intuition in the investment world. And the reason why is the investment world, unlike chess and martial arts, is not a closed system. Chess and martial arts are closed systems, whereas investing is not only an open system, but it's a complex adaptive system. Things are non-linear and there's a lot of hidden information. Your intuition may be just emotion, really. And you have to be careful having intuition there. And Michael mentioned that you should have what Danny Kahneman calls discipline intuition, where you study everything, especially the environment, the bull case and the bear case, and then you use your intuition to kind of come to what the answer is, constantly testing that intuition. Um, I can't argue with those two guys. Those guys are way smarter than I am and understand those two fields. But I think I have a one thing that I would add, which is an observation that I made once, which is the people in investing that have the best intuition are in my are from what I've observed are the ones with the best networks. And the reason why they're the ones with the best networks is, in a way, the market and businesses being a complex adaptive system, and their network also being a complex adaptive system. Their network often filters the information from the market through the network and to them. And in that filtration process, they're able to see what's happening, especially the nonlinear asymmetrics and also what they call systems thinking emergence. And you're able to say, hey, my intuition is telling me that we got to pay attention to this, right? So I think you should trust your intuition in investing more if you have a developed network that you can test these intuitions on, or that information is coming to you via a network of other highly capable investors. I would say that's what I would add to that. Um, I would add also that you need a self-awareness process, okay? Um, um, know yourself is vital in the investment business. Uh, uh, to have a journal process, to have other smart people give you feedback. We have a portfolio analyst now that does consulting for us where he analyzes our portfolio. And I'm constantly learning. I'm like, yep, that's good. That's good. I'm learning. But my God, is it painful. And after a session with them, I always need like an hour of self-caressing and be like, it's okay, you know, you're gonna get better. And I need to be held at night because I'm like, I can't believe I was that bad at something that I thought I was actually good at, but I'm showing the numbers. I'm like, nope, I'm not good at all at it. It's actually a very common thing. But once I have that, I have no choice. And also, I will break apart anything in myself to be able to improve at my craft. So now it's just got to get better. Okay. Fuck your ego. Fuck your weaknesses. Fuck your insecurities. Doesn't matter. The only thing that matters right now is getting better, putting up numbers for my partners, my friends, my family, and myself, and that's it. Um, so that self-awareness process has to be both quantitative and qualitative. And there should be things written about that, and there are things that you can do for that. It's important. But again, study the great investors and the investment space and the sports space and intelligence and the military. And you want to study the best. And then last, you want to study failure. And through that, your intuition and your pattern recognition will speed up. Okay, Joaquin says, I'm an inspiring analyst wanting to get in front of PMs. How should I build a content strategy, YouTube or Twitter? How would you do content if you were starting out again? I would do it the same way that I've always done it. By the way, to create great content, you have to read. Have you read all the books relevant to the investment world? Have you read all the books relevant to companies that you cover? If you're not doing that stuff, you're not going to have the inputs that you create the content with, right? So that's the first thing is, as a young person, is have you read all of this stuff? It'll probably take you a good 2 to 3 years. And the good thing, frankly, is you can actually do it one by one. The um uh I think that I think Patrick O'Shaughnessy he did a presentation once at Columbia Business School where he says, you want to learn something about a topic, create a piece of content about what you just learned, share it with a lot of people, and repeat and constantly do that. Right. So if you read a book, did you create your own Substack where you actually detail what you've learned about the book and then over time add stuff to the commentaries? Like, have you created a body of content like that from stuff that you've read? You should read a book a week, and then Sunday afternoon, take your notes, your favorite quotes from it, create a piece of content around it, share it. Create that body of content over time. We know guys that have done that. Um, uh, um, so that's the first thing, and then share that across YouTube, Twitter, and Substack. If you're gonna write about ideas, if you're doing it on Twitter, make sure you do it under a pseudonym and make sure that you're able to get feedback on that idea and also very liberally delete shit. Okay, just delete stuff. I used to have an idea Twitter account. It got up to like 40,000 followers. I no longer have it for a bunch of reasons. I don't think I'm allowed to have one now, but we no longer need to get that feedback publicly because now all I do is take my memo and share it to some of the best investors that I know. So we don't really have to have public feedback on it, but that's actually something that you should be doing. If you don't have people in your environment to do so, put it on Twitter. People will give you critique. Another thing that you should do, by the way, uh, um, in your content, in a way, you create content to grow your follower base. One of the things that having a content strategy enables is this modern tool called crowdsourcing. It's very valuable to be able to go on Twitter and ask a question and get stuff, or LinkedIn. For example, I put on my LinkedIn, hey, I'm going to Italy, and comes back an introduction to a firm that's changed the game for us in the last month and a half. This badass investment firm in Italy. I walked out of that meeting. I was like, oh my God, those guys are good. And just studying them has led us to really improve our game in the last month or so. I would have never had access to that had I not put that stuff on LinkedIn. But also, I would have never had access to this particular introduction had I not developed a following, apparently, in Italy, right? So this is why it's important to have that. But how do you design content? How do you design a piece that not only it adds value to people, but people want to put the share button and it grows your 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 follower base. It's stuff that you have to think about. You have to be very strategic about it. By the way, if you're designing content, have you studied the talks that Mr. Beast has given on how to design a piece of content? Have you read books on writing? Have you read Stephen King on writing? Hemingway on writing? Have you read Writing by Zinzer? Have you read The Elements of Style? Did I get the title right? Have you read Writing Without Bullshit? Have you read? You have to. You're going to create something that's super high leverage. Spend the time studying writing. Have you read Ogilvy on writing? He wrote an essay on that. Have you read Scott's book? Scott Adams wrote a book, a memo, an essay on writing. Have you read that? Must read. So, if I was starting again, that's what I would do. By the way, we write for a particular niche, which happens to be, I would say, very rich business owners, portfolio managers, analysts, and individual investors. This is like it's kind of I'm not writing for, this is what I write for. It's not my intention to have 2 million, 3 million followers. no desire whatsoever. If you look at, I guess my anonymity and my niche is gone down, but outside of my niche, no one really knows who we are. We like that, like a lot. Okay. All right. Dylan Horowitz says, what are the biggest lessons you've learned shorting stocks? What makes someone successful at shorting in today's market environment? Conversely, how can one fail at short selling? What are the pitfalls to avoid? By the way, Dylan, I would definitely start by doing, we've recommended this before, by doing a failure points analysis on the short side. So make a list of 30 of the smartest short sellers you know. Buy all the books on short selling, study them, and then go meet these people and say, hey, what are the failure points of great short selling, and cover everything. Idea selection, portfolio management, how do you size a position, risk management, due diligence, tools, field work, and really try to figure out. But let me try to list some of these things for you. Let me do your homework for you. Okay. First, you don't short big before the stock first crack. You short big after the first crack, meaning a stock is like this. Okay, it's going up straight. No, that's not when you short it. You short it after it does this, preferably here. Okay, why? Because when a stock is going up, straight up to the right, up and the right, analysts, the narrative, they're all asking bullish questions and getting bullish answers. The perception that you have, it's not in the price yet. There needs to be the negative perception you have, there needs to be an event that happens, an earnings miss. And then here, because the stock is overvalued still, even though it's down 20, you're able to short it after that and still capture a 30% move. Whether you capture it before or after, that down move is still 30%, no matter how much, it's so what you missed the first 20%. So we tend to short after the first earnings miss, right? When the chart is cracked, when the narrative is going negative, when the analysts are asking, hey, we were bullish, but maybe, capacity is coming on right now and we have to be careful. Okay. And then now, one of the ways you know that, by the way, especially if you go to group meetings, is you start seeing other hedge funds ask the bearish questions. And the management team is like, wait a second, everybody was only being nice to us and asking bullish questions 3 months ago, but now people are kind of negative. And you see that look in their face like, whoa, something's going on. Generally a good time to short. Okay. The second failure point is people tend to be too big on the short side, position size wise. I would cut the position down. We don't short more, very rarely more than 1%. It's rare that we have more than a 1% position. And if we have bigger than that, it tends to be for a short period of time because we have a very defined catalyst. For some reason, that happened like 3 times last year, but that's unusual for us. The other thing is you want to have a lot more shorts than you have longs. We tend to have 2.5 to 3 times the number of longs that we have on the short side. The third is there's a lack of misunderstanding that management teams today are way more sophisticated at understanding what the short case is on their stock, who the short sellers are, and what the positioning is on the short side. There are consulting firms that help management out with that stuff now, right? So the good management teams actually take advantage of that, right? So you have to be careful. If you're with a management team that understands that, and you kind of need to ask some questions. So if you're with a management team that says, "Hey, do you understand the short case?" and you want to see how sophisticated their responses are, you know, um, you know, one of the questions we like to ask management is, um, what do you think is misunderstood about your business or your stock? And very often, a great management team will actually give you what the narrative and market perception is, and then why that's wrong. Literally giving you the variant perception. They won't do it for an MNPI way, but they'll do it for the next 3 to 5 years. And good management teams can actually do that, right? So when a stock is very heavily shorted, and you speak to a management and they understand the short case a little bit too well, I would be very careful if you were short still. On the contrary, it's probably time to redo your work, and odds are it's probably time to get long, right? So you need to understand that this battle between the bulls and the bears, a great management is going to understand that, and if not outright manipulated. By the way, it's very important to understand that sometimes a management team can obfuscate the information that it gives out to get people to be bearish, so that that bearishness, when the positive catalyst happens, that bearishness needs to change, and that can add fuel, because a short seller is a deferred buyer, right? So the when the short is covering, he has to buy, and if that's happening at the same time that other people are buying, believe me, that can be very painful, and it can be a hot octane for the stock to go up. Okay, now, because a failure point is not understanding the return on time of short selling. So because your position sizes are smaller, you actually have to be careful about the amount of time that you spend on a short, right? If it takes you a week to understand a 1% position size, it's probably too long. Okay, because you have to as an analyst, that means you can only work on 50 shorts per year. Today you have to increase the velocity of names that you understand. I think, and by the way, with some of these AI tools, AI can speed some of that up. But return on time is important here, and generally you have to become very good when you get pitched a stock or when an idea comes in, that you can very quickly isolate what the issues are and be like, okay, we got to short this, right? um, okay. um, the other failure point is trying to short stocks without a network of other short sellers. You need a network of other short sellers, okay? You need guys that understand what you do, that can give you advice. You can collaborate. You can work on ideas together. Um, and they've seen stuff, and they can be like, hey, I would be careful here, and give each other advice. Now, it's rare to do. Short sellers tend to be very individual creatures. Others are worried about their borrow, and that borrow is going to dry up if you know my idea. But generally, I think that's all bullshit today, because if you're short that stock, odds are short seller is short too. Now, there's a debate today as to whether you should be short stocks that have high short interests. And me, I don't mind. I love when something I'm short has high short interest. We just wait. And what you should wait for is a short squeeze. We short something after it's squeezed, where it's squeezing because of positional reasons and not fundamental, and short it after that. Generally, it comes right back down after, right? So it's not that you should never short highly shorted stocks, because they tend to work over time to the downside, by the way, because short sellers tend to be right. But you should just do it after a short squeeze. Okay. One of the reasons why you need a good network of both short sellers and other investors is it helps you do the behavioral work on a short, right? So what behavioral work is, let's say you're short a company that it's levered, right? The equity is, let's say, $1 billion, but there's 4 billion in debt. Okay, well, have you actually called the debt holders and have they helped you understand how they're using the equity to maybe hedge out their bonds? You know, that could be impacting what you're short. Have you called other bulls and done a bull bear debate with them on the idea so that you understand what their thesis is? It's not unusual, by the way, that we're bearish on a name, that we debate it with a bull, and the bull convinces us that we're wrong. Like, yep, we're wrong. I get it. Pass. Or we turn around and go long, or it's not unusual that the bull realizes that he's wrong and he's like, hey, we need to get out of this thing and today. And we're like, wait a second, if he's having that reaction, we know 20 other guys are going to have that reaction once the event happens. So the behavioral work on the short side is very, very important. Um, Portfolio managers, by the way, have a few tools at their disposal. One of them is cross-referencing an idea. So your analyst pitches you an idea. Can you then take what he's pitched you and talk to different market participants, pitch them the idea and see what you cross-reference it to see what comes back, right? The second tool is the bull bear debate. You're a PM, your analyst wants to be long. It's like, yeah, hold on a second. So as he's pitching you, you're like, you know, you call a guy that you know is short. It's like, hey, Mikey's short. Mikey's long. I know you're short. Why don't you guys debate it for the next 10 minutes? I'm going to listen in. Okay. Very powerful. Now, it's almost unbelievable how tense it gets during these debates. But then that tension, when the bull starts fighting the bear, by the way, it's not unusual that literally fist fights could happen. you know, I've made the mistake sometimes of doing these things live when it gets heated. I love when that happens because that tension is a mini example of what's happening in the marketplace. It's not unusual that names like "fuck you, you're an idiot," and here's why, and that's why you lost money the last time. Like it gets heated. I love that, and your job as a PM is to actually keep things economic, you know? And you're like, hey, let's don't make it personal. Okay. I had an analyst that was very competitive, especially if he was talking to an analyst at a bigger fund where the analyst was making more money than he was. And his job was to destroy the other analyst. And I'd have to call him down, like, hey, calm down, kind of rein him in. And then, make sure that feathers are not ruffled on the other side. But it's very, very important to do bull bear debates. You got to go on Twitter and say, hey, are guys on Twitter talking about this idea? What are the bull points? What are the bear points? There's a community of guys that short stocks on Twitter. They're there. By the way, a lot of that stuff is moving now. It's moving to Substack that are private. It's moving to private communities on Twitter even. So there's a lot of adaptation that's happening there. And you got to have the chops to be invited to these things, but it's useful to do. Another tool is the research compilation that I was talking about as a short seller, where you understand the narrative. We were talking about this before. Okay, last failure point, because I'm spending too much time on this. Accounting issues are not enough of a reason to short a stock by itself. Okay, the accounting looks like shit, and DSOs, receivables, something weird, they're shifting shit. That's not enough to want to short a stock. Mm-mm. You need more than that. Second, the stock's overvalued. That's not enough to short a stock. Who cares? Michael Jordan was overvalued his entire career, and yet that guy put up points on the board. Okay. Like, and by the way, human beings are terrible at knowing what something is worth. Okay. Some dude just paid 5 million bucks for a banana. Okay. Like be very careful shorting something because you think it's overvalued. Uh, uh, Management misrepresentation by itself, also a terrible reason to short a stock. Okay. The management team just lied. Mm, so what? Plenty of the world's greatest entrepreneurs, they don't call it lying, they call it the reality distortion field. But the amount of misrepresentation that I've heard from great CEOs where I'm like, does he not know that we actually read the 10K or 10Q and what he just said is totally provable that it's bullshit? It's very common. But guess what? Doesn't matter because sometimes it's actually the guys. There's a famous entrepreneur businessman that I love and respect. He says, I've never known somebody that's made it big, really big, that wasn't at least a little bit fake it till you make it. Okay. We call the entrepreneurial prerogative. An entrepreneur says, I'm going to do this. Is that a lie? It's probably a misrepresentation. But what you should be doing is the work to say, okay, if he only does half of that, are we still doing well? Okay, fine. Give him that discount. But very often, these great entrepreneurs are, if not lying, at worst, they're misrepresenting and showing you a picture that doesn't exist yet. That is most likely bullshit. But it's very convincing and they convince smart people to make it a reality. So if accounting by itself isn't a reason to short, overvaluation by itself isn't a reason to short, misrepresentation by management isn't a reason by itself to short, these three things together, plus the granddaddy of them all, which is competition. If you know a business that is getting wiped out competitively by something, where their moat is being breached, there are marauders penetrating the moat and the castle, plus there's accounting issues, plus there's overvaluation, plus there's management misrepresentation, then you've got a great short, right? So, but we tend to like competition shorts. And by the way, I love the frauds. I love shorting frauds. Okay. They're tougher to find and they are really a in many ways, pre 2020 situation. I would say pre 2021 situation. They still happen. But today, even fraudsters have gotten very sophisticated legally to be able to protect themselves legally from a fraud. But I would say that competition shorts, frauds, fads. These are all things that we like. Cyclical shorts. I'm a open opportunity short seller. I hope I covered and answered your question. By the way, Dylan, ping me if there's more. Okay. All right. Jace Pando says, what are some best practices for young analysts hosting idea dinners, cadence, curating the guest seating charts, the space? The cadence every couple months, once a month, the guests, whoever you have access to and curate over time, seating chart, make sure you sit people next to each other that don't know each other. Okay. My mother is an amazing hostess. And she had a bunch of rules about hosting. She says, A, amazing food, amazing alcohol. Got to make sure that it's both. Second rule, always separate couples. Okay. Never have a husband and a wife sitting next to each other, because what you have is little pools of silence everywhere because they know each other. They're not going to talk to each other. So always separate the couple. Sit them across from each other, right? But next to the each person should be somebody that they're getting to know and that it's engaging conversation. And then third, let the booze flow. And I think that for idea dinners, you got to place people that don't know each other next to each other, and then you have to curate the idea. So you say, okay, I'm gonna John, you speak about your idea first, and then you give him timer in hand, 3 minutes to pitch the idea. Then you have the back and forth on it, and then the next guy comes on. If I were you, to minimize everything, you have to do a couple things. One, choose the food for everybody. Ask if anybody ahead of time is a vegetarian. There's a vegetarian deal, but choose everything. You want to reduce friction for whoever's attending. The second thing is you want to choose a room where it's kind of quiet at a restaurant or somewhere else if you're catering, where it's kind of quiet, because sometimes the noise from a restaurant can be pretty bad. Um, um, the second thing is, just as a dynamic, is let's say you have 8 people there. You want only 4 credit cards to pay for the entire thing if you're not paying for it. And what you do is you have 4 people pay, and then the next day, whoever owes messages or Venmos the person what they owe. And the reason why that does that is it creates a mini network where the next day, not only are they connected financially, but one guy might say, hey, can I ping you on that idea? And now they have each other's information, right? Because you kind of want, as the host of the idea dinner, you want people to be talking to each other. If you're good, believe me, that information will come back. Some of the best idea dinners I've been to, where I've been pitched stuff that are unbelievable. I remember when somebody pitched me Netflix in 2012. It was at an idea dinner, or even Altice, that came out of an idea dinner. Even Valiant, when the first time, as Valiant was going up, the first time we heard about it was actually an idea dinner, right? So I would say there's that. You can run them on Zoom today, by the way. I prefer when they're live, but you can run them on Zoom. Okay, next question. What do most senior PMs tend to undercapitalize on when it comes to their network of young rookies? Senior PMs don't use the young enough in the field. The young guy, send him into the field to talk to customers, suppliers, competitors, to try products, to go to conferences. Send them in, pay for it, and have them report back to you, the senior, with pictures, answers to questions. Have it do it live. Sometimes one of my guys will literally be like, hey, do you mind if my PM listens in? Like, literally puts his phone there and I participate on Zoom to a live meeting. I love when that happens. Um, 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 do you know the we mall visits? Send a young guy to the malls and walk the malls in Texas, walk the malls in New Jersey, walk the malls in LA. And what comes back? What new products people are using? What new restaurant chains? That's how we found one of the hottest restaurant chains right now, by the way. Can't wait to get our hands on it, stock wise. So field work is, don't stick to kid doing models. There's no more edge in models, guys. Once you've learned how to do a model, now Claude, you push a button, the model gets done for you. Understanding the drivers of the model, understanding what an idea could be, that's going to be the stuff that matters. And in my opinion, you do that in the field. So going to visit, by the way, we like the tag team approach in the field, meaning if I send a young guy in the field, I want him to be usually with a senior guy. You know, that senior analyst, young analyst tension can create some interesting dynamic. It's like the old bull and the young bull. There's a really funny story about a young bull and an old bull on top of a hill looking at a bunch of cows, but this is a family show, so I won't mention it. But that tension where the young guy wants to learn, the old guy, you know, knows and has the scars, and he's kind of annoyed at the young guy's experience, but he still wants to answer the questions because he has to. That tension can create a lot of magic in the investment world. It's also very powerful if you send a young guy in the field with a seasoned operational executive that's retired, knows the industry well. That can create a lot of good dynamics. You know, by the way, the senior guy is going to ask a question that the young guy's never heard of, and that's how the he learns. The senior guy is going to ask the young guy, "What do you think of that meeting?" And the young guy is going to be like, "Well, I thought this was important." And the senior guy, "That's not important at all. Here's what's important." And then you have them write the memo back to the PM together. That can be very valuable. And Let's step back. As a leader, you have to know how to create tension, but tension that when that tension dissolves, it helps you accomplish a goal. Right? So, what do I mean by that? This is, well, if I do a bull bear debate and I create bullish arguments that are in tension with bearish arguments, when we do the work to resolve the tension, odds are whatever resolves the tension is the reason why we're going to make a lot of money, both on the long and the short side. Okay. So when you send into the field the senior junior tension, it's very powerful and can lead to a lot of magic, frankly, where it's like, hey, where'd you guys get that insight? And odds are it's when they were fucking arguing, when they were in the field, where the senior guy's annoyed with the junior guy. The junior guy's thinking in his mind, dude, you're a combination of an unk and a boomer. And why am I fucking listening to you? And then in that argument, right, the PM is like, hey, you guys, we got to spend more time on this thing you guys are arguing about, right? And there's other things that are undercapitalizing on rookies. And I'll share one thing. So we tend to like analysts that know the blocking and tackling of financial analysis and that show decent judgment, but that have not expanded their moats yet, right? So just like a company can have a moat, and the moat is either expanding or shrinking, an individual can have a moat, and that moat is either expanding or shrinking. Okay. And when you catch a young analyst early enough at a time when his moat is expanding, you can make a lot of money with an analyst like that. So, how do you put the analyst to a developmental program that expands his moat? Okay. And as a PM, it's your job to expand the moat of your people. By doing that, the moat of your firm expands. By the way, hedge funds are very fragile enterprises. Okay. And you can never really get rid of that fragility, but there are things you can do to lower it. But a hedge fund can have a competitive advantage. And there are things you can do to expand that competitive advantage. And one of them is make sure that your people, their individual moats are expanding. And how do you do that? All right. Jay, say you've been pretty consistent in your view on the necessity of analog skills and being very careful with the use of AI, especially for young people. What about your views against AI use in the investment process has changed over the past 6 months, if anything? Nothing has changed. The tools have gotten better. But again, just like I covered earlier, Has it improved performance? Um, as of now, we see how it reduces costs, both financial and temporal, but we don't really see if it improves performance yet. We're amazed at some of what it can do, but it's unclear. And again, I'm going to refer you guys to that Joe O'Donnell, Brett Cochran podcast and the points that Joe makes on whether judgment will ever be solved by AI. It's interesting. Okay, do you have any recommendations on drills a PM can do consistently and with relative high frequency alongside their analysts to improve coherency across the team and to better learn how to supercharge the attributes of your troops? Fuck me, that's a good question. Okay. Yes, there are. Okay, do you guys, who knows about, okay, let's go this way. Who knows about the 2-minute drill for quarterbacks in the NFL? Right? What's the equivalent of a 2-minute drill for a portfolio manager? It's interesting. Here's a few thoughts. Okay. Um, let's start with 4 hours to kill an idea. It's very important with an analyst. As a PM, you hear an idea, you think it's really compelling, you call an analyst and you say, drop everything you're doing for the next 4 hours. I want you to figure out how to kill this idea. And you're going to present it to us in 4 hours, the entire team. Okay. So the analyst has 4 hours to determine, hey, should we actually be working on this thing? Because one of the problems with investing is return on time. And sometimes you tell an analyst, hey, do you think I should be doing this idea? And it takes them a week, a fucking week. If you think about what a week is, by the way, 8 times 7, that's 56 hours. It took you 56 hours to determine if this idea is good or not? No, 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 no. That's way too much time. You have 4 hours to kill this idea. Now, how do you come up with a process that takes 4 hours to kill the idea? AI is helpful for this, by the way. So 4 hours, by the way, we can't share what our process is because of contractual reasons with my partners. This is partner level information. But if I were, okay. Read a 10K, a 10Q, and a transcript. The last ones, 10K, which is a CEO letter, and the 10K, you don't have to read the whole thing. I would read the risk section. I would read the management discussion. I would read the compensation structure, go through the income statement, the balance sheet. Okay. I would go on Capital IQ, Ticker, or the other thing just to come up with, hey, wait a second, what are the bullish points people are making on it? What are the bearish points people are making on it? Third, I would do a price implied expectation on the idea. So that's a Michael Mauboussin framework where you put in revenue growth, margin, return on invested capital that the street thinks the idea can do, and find out what the assumptions are that are embedded within the idea. You do something you call up, you look at the holders list, see 5 of your friends that are long, call them up, have them send you their memos. Like do whatever you can to come up to speed on the idea fast. So that 4 hours to kill an idea, by the way, there's other things that are way more sophisticated than that. Trust me, you'll find it. But as a PM, you want to be able to tell somebody, hey, you got a couple hours, long or short. Let me know very quickly. 4 hours. The second is the Jeff Bezos memo reading process. Okay. So whether it's a strategic piece about the business and how to get better, or an idea memo, 5 to 7 pages, That's it. You get the entire team together, okay? For the first half an hour, you read the memo and then you discuss it for the next 90 minutes. Very powerful as a process. If you're looking for the process that describes this, there's a book on Amazon actually called Working Backwards. And by the way, the chapter on hiring and working backwards is literally the best chapter on hiring I've read. But it's important to it's a chapter on communication, the narrative in the 6 page or chapter 4. It's important to read these memos together and have discussions. By the way, don't fucking use AI to write the memos. Okay? Maybe use AI to edit it, but let's step back a second. One of the most valuable qualities and values in the investment business and in an AI world is authenticity. Okay, authenticity in a world where AI is going to average out everybody is going to be a lot more valuable. By the way, there's a theme popping up right now called, we call it the rise of the authentic leader. People are so thirsty and ravenous for authenticity that when a leader pops up that's authentic and he's not afraid of being himself with all the issues and warts and securities, weaknesses involved, and the strengths, people have a yearning for that, right? And you want your memos to be authentic, so spend the time really thinking about the point you're trying to make and be able to defend that point with facts and also qualitative elements. We have a process called that we stole from a very famous PM. We call the blood process. I think that's his name for it too. It's portfolio blood. So on a Sunday, paying any analyst that you're collaborating with on ideas or that's working for you and say, hey, I need to free up 50 basis points. So you've got 10% of our equity right now and the ideas that you cover. What would you sell? I need 50 basis points. And your goal as a PM is to free up the next day 500 basis points to allocate to a new idea if you hear it. But that forces the analyst to be like, hey, I want to keep this, or I want to sell some of this. And it kind of forces, it's a forcing function for constantly replacing good ideas with better ideas. That's actually one of Julian Robertson's portfolio management principles, where he says, always replace good ideas with better ideas, and you need that portfolio blood process. And one thing that we've learned also is the entire team on a weekly basis, on a Sunday, go through every single idea in the book, everything, go through it, where somebody says, hey, and you record it. And then, and that is actually a really good use for AI, where you do it on Zoom, you record it, and then afterwards you ask Zoom, what were the main points of it? And then you allocate to everybody, okay, this is what you got to do. So, so you got to go through everything. Stepping back, I think your question is very good. It's not only to improve the coherency across the team, though, it's also to defeat complacency. Complacency is the enemy in our business. It's a quote that I first heard from Chase Coleman, and I believe he got it from Peter Lynch's book, One Up on Wall Street. Chase said, complacency is the enemy. It really is. And you have to fight complacency and your team and your portfolio and yourself and your processes, because the market's always adapting, always improving, always evolving, always changing, and you have to as well. So weekly meeting where you go through the entire portfolio. Tag team, never send an analyst into the field by himself. Send him with a senior guy or an operational executive. Also, try to send him into the field with somebody else from another fund, for example. Um, these are all things that you can do. There are other things that we can't talk about. Um, I can talk about it at a higher level. Thinking of differentiated research structures. So for example, sending a junior guy sending a senior guy with a junior guy into the field, that's a mini structure. It's differentiated, but you gotta take the structural edge of research to another level and really be creative about it and think about it. And because it structure drives behavior, right? And if you're looking for elite investment behavior, odds are you got to change the structure. So you got to be thoughtful about that. Um, by the way, um, one thing that surprised me about the content strategy, by the way, that surprised me to the upside is there are things that I discuss that I think are vital that no one cares about. And yet, it's the reason why we perform. And yet, there are things that I mention that, and like, it's okay, but yeah, that's everybody wants to talk about that. And then it changes by geography. Like, for example, I have a lot of followers in Brazil. The things that matter to them are very different than matters to the Americans. So it's really interesting the geographic mix that you get back, and I think that's interesting for itself. Okay. All right. When trying to analyze a long term, so this is from Rohan. When trying to analyze a long term opportunity for a business, how do you think about companies that are disrupting themselves? I have a specific example in Essilor-Luxottica, where the business is the clear leader in traditional eyewear, but is investing time and money aggressively into smart businesses. It's very unclear how demand will shape up for smart glasses, and the shift would likely be disruptive to Essilor's P&L. So how do you approach these kinds of cases? That's the $1 million question. By the way, we love disruption. Even more so self-disruption. It's just hard to find. To be fair, and the example that you cited, which is Essilor-Luxottica, they have a moat, right? They are self-disrupting within that moat. So what's their moat? Well, a lot of their moat is their stores with the ophthalmologists and the stores, right? A lot of their moat is the brands that they have. A lot of their moat is also their way of thinking. Del Vecchio, his competitive style was equivalent to mafia-like tactics, legal, but this guy was a competitor, and he was mean competitively. I say that with full admiration, by the way. I was a big fan of his before he passed. So when you're disrupting, but you have a moat, it's probably a healthy self-disruption. So let's step back again. When Walmart went full on into e-commerce, they were able to do that because they already had the store bases, which are physical moats themselves that compete against weaker players around them, by the way. They had the logistics, which is another moat. They had supplier arrangements, where they basically use their suppliers as growth capital with their payment structures. And by the way, they beat up on their suppliers all the time. They had all that stuff and then added e-commerce, search engine optimization, and other e-commerce tactics on top of that. So they self-disrupted within already a physical moat. Now it so happens that EssilorLuxottica, makes, actually this is Warby Parker. I think Warby Parker is a very well-run company, and I love the product. But when you look at self-disruption, something where you have a moat, and also within an industry structure like theirs, which is highly fragmented. So I believe there's 45,000 eyeglass stores, and half of those are mom and pops, and the other half are run by businesses. So those competitive dynamic and disruption within that, it's better than disrupting within an industry structure where it's very, very different. If you look at Carvana, for example, Carvana has less than 2% market share right now, right? And the fragmentation of the space is massive. By the way, there are logistical and geographic reasons why the used car and car dealership space is always going to be fragmented. But these guys are trying to pursue and use tactics and technology to be able to gain market share, and in a way they're self-disrupting. But I think they're not self-disrupting, they're disrupting the industry themselves. But you want to think about disruption within an industry structure. Okay. You say it's very unclear how demand will shape up for smart glasses, and the shift would likely be disruptive to SLR P&L. Yeah, but I think they know that, and they're going to. By the way, I personally think that smart glasses are the future. We've tested almost all of them now, and the new Google ones, for example, are incredible. I haven't seen I guess the Apple ones are the only ones that I haven't tested. Um, but the insight we have there's two insights we have. One is there's a stigma associated with when you speak to somebody today and you're wearing these things. And what it reminds me of is there used to be a stigma in the early 2000s about online dating. But over time, online dating became the norm, right? Before, it was really weird people that dated online, and people had a negative connotation with it. But today, it's actually normal, right? Today, there's a stigma with people that wear glasses that are recording things or maybe showing you things as you're speaking. But there is a probability that that stigma might go away. So I would say that that's the first insight. And you kind of want to see signs of people in your life that use them. And you say, oh, I'm okay if you wear them. I don't care if you're recording this, or people that don't. So just check on that and understand the nuances of when that stigma is going to lift. Because if you understand when that stigma is lifting, that could be an inflection point in the sale of these glasses. The second is from our usage of them, we actually don't believe it will be younger people that buy them. We actually believe it will be older people that buy them. And these older people, when they buy these things, it actually will be the gateway drug to them using both AI tools and other internet tools that they've never used. So, by the way, the third thing is having hung out with the engineers that that have developed these things. They've told me about certain use cases that are not only hilarious, but I can't describe them because this is a family show, but it's similar use cases that when the internet started, even though people made fun of the internet, those use cases probably told you that this thing's going to be big. right? So we kind of know that these glasses are it. By the way, the other reason why we know it is going to be big, these glasses are already in the military. It's not even certain special forces when they're underwater, their goggles can actually tell them where other their teammates are, right? And how far you are to whatever target you're trying to get to. So we know these glasses are coming. Um, uh, but disruption, the last thing I would say about disruption to answer your question, Rohan, is that disruption is not about prediction. It's about observation. So sometimes you think something is disruptive or is about to disrupt, but some businesses with moats either have a competitive reaction to start self-disrupting, or their moats are physical and it's really hard to dislodge those physical moats. Like for example, we love this business that makes highways and owns highways. Is AI going to vibe code a highway this weekend? I don't think so. Right? By the way, right now, Chris Hahn's portfolio, especially with the recent changes, try to vibe code anything he owns right now. It's gonna be hard. It's gonna be hard, right? So disruption is about having a day-to-day process. So, excuse me. Disruption analysis is about having a day-to-day process to observe examples of the disruption happening. It's something you have to observe. It's difficult to predict. No one saw Amazon coming for the first 6 years from 2002 to 2008. Hell, they're not seeing him coming now. There are things that Amazon does competitively that its competitors have no idea that it's doing, right? So you need to be in the field. You got to have examples of the disruption happening or not, and then you try to blow that out in your analysis or not. Okay. How did you launch? So T Sojritawa says, how did you launch your own fund? Any thoughts on my fund strategy being the following? We invest in firms which are developing their competitive advantages, but have not yet done so, as well as firms which clearly have an opportunity to build a second greater business on top of the current one. And he cites Airbnb as an example. And also, on a personal note, can I get your email? Would love to chat. Okay. So, by the way, excellent strategy to invest in businesses that are in the process of building their moat, right? That's when you make the most money. You make the most money when a business is in the process of building its moat rather than when it has a moat and it's just getting that ROIC. Now, imagine this. I'm a professional gambler and I make $2,000 a week. Okay. But all of a sudden, I start making $4,000 a week. So in many ways, my return on invested capital just went up. What has happened to my moat? Well, if you think about it, your moat has expanded. There's something you're doing. There's a competitor that you're gambling with, which is that you're making the same amount of money, assuming that your bankroll, the players you play with, stay the same, right? So step back a second. What is a company doing that is expanding its moat? By the way, one of the insights that Michael Mauboussin has, which I think is a genius insight, says that it's very hard to prove quantitatively that a company has a moat. That the only way really that you can quantify it is if the company earns returns on invested capital above their cost of capital. If they can do that for a sustained period of time that he calls the competitive advantage period, They have a moat. So when a business, if you track their ROIC and the ROIC is inflecting, odds are something is expanding the moat. And some people actually have no idea. They just know they gotta uh, uh, track the ROIC. But hold on, it's really powerful. And between a quarter or a year period, when you know the company is doing something to expand its moat, and it hasn't been reflected in the ROIC yet. Those are the ideas when you can really make a lot of money. Okay, so I think your strategy is excellent. By the way, if you think about, you think your strategy of finding a business that has an opportunity to build a second greater business on top of the current one, phenomenal. Think about Amazon. They build AWS on top of Amazon, right? By the way, they're now building Amazon Marketing Services on top of that, which is an incredible other business. And then there's other businesses that they're building on top of that too. All of a sudden, Trainium chips. Amazon is building those. I mean, what a badass company. Oh my God. Like, like talking about Amazon is like sex for me. Okay, it's incredible as a business, as a culture. I love Jeff. I love Jesse. I love Joy. I've never met somebody that works at Amazon who's like, yeah, that guy's a chump. It's never happened. Never happened. So think about how powerful that was. You're invested in Amazon, and all of a sudden AWS pops up. It took some analysts a couple years to understand how powerful. There are people that still misunderstand AWS today. Okay, so it's a great strategy. Nothing else to tell you. Um, by the way, we do both of these things. Um, you know, the way you launch a fund is you need your initial backers. In my case, I had three people, one of them a family, and two individual that were willing to invest in me from the beginning. Other than those guys, we've only raised money from, so within the family, there's a bunch of people, but outside of those two initial guys, we've never raised money from, except for one person who came in literally at the bottom of us and has been writing, has been doing well since he's like a good luck charm for me. But you know, we're starting our marketing at some point in the next 6 months. I'll let you know how it goes. To launch a fund, you need your legal documents, you need your business plan, you need a presentation, you need a prime broker, you need trading relationships, you need to solve for the top of funnel on the marketing side, and you got to go meet 200 people to get 10 investors. If you have a higher success rate, good luck. Okay, so I mean that's how you launch your own fund. I mean there are tactics and strategies you can do, of course, but that's pretty well known. A couple of pieces of advice: keep your costs low. Okay, hedge fund cost structures have gotten out of control. You don't need to impress allocators with, your Capital IQ, Alpha Sense, Bloomberg. There's no money in that shit, anyways. Okay, it's like yeah, you need to analyze, but expenses are way too high in the investment business. Okay, if you look at cost structures of hedge funds in the 90s and the aughts versus cost structures today, I mean it's like night and day. And I actually believe that these cost structures that are much higher are the reasons why hedge funds are so fragile today. Okay, like guys are shutting down for nothing. The guy's down 20%, he's shutting down. I mean, 20%. Like you could make that up in a quarter. Like what's going on? Allocators are leaving you. That for it's the hedge funds have become too fragile, and part of the fragility is that cost structure. So be careful on the cost structure. The second is, um, um, by the way, here's what you got to do. We'll put that, I guess, in the show notes. Um, I have a YouTube on this, um, on how do you solve year one. Um, Hedge funds are so year one dependent that you have to know how to kind of hack your first year and how to think about it. Go watch that. By the way, um, so to your question on investing in businesses that are developing their competitive advantages, um, moats today are misunderstood in our opinion still. And they're usually misunderstood across a bunch of verticals. The first vertical is the static versus dynamic vertical. You know, people tend to think of moats as static when in the real world they're dynamic. If you think about even the analogy, moats and economic castles, the moat, you look at a castle, it's not moving around. I mean, sometimes at night somebody's adding crocodiles and piranhas to the moat, like Uncle Warren says, but generally it's like a static thing. And even like barriers to entry, it's a barrier. Is the barrier expanding? So people have grown to think of moats as static, when in the real world they're dynamic. They're constantly either expanding or shrinking. The second is defensive versus offensive. So people tend to think of moats as defensive, meaning you're in the castle and your moat is stopping somebody else from coming in to your castle. Or barriers to entry, which is you're trying to stop a competitor with your barrier from entering into what you have. Guys, the only thing that matters with moats is how to use them offensively. How do you use your moat offensively against other companies? The third is visible versus invisible. People are very good at talking about the things that a company does that are visible. But what a company does that they can't talk about, that's invisible, they have no idea what it is. Okay? And then within a moat, you have variables that move really fast, and people think that those things are the ones that matter. And then you have variables that move very slowly, which are the things they have a hard time handicapping that really matter. One of those things, for example, is culture, right? The culture of a business. And when you read a book like this, you really realize what some of the rituals and values that Amazon has really creates their structure. By the way, maybe it's worth reading chapter 10 on AWS right now in this book. But anyways, so I hope that's helpful. Okay, we're still going. 26-year-old PM here, running a quantitative derivatives fund, mostly and formerly Indian markets, currently working on a formalized legal structure. I followed your work for a while, thank you. And it's shaped a lot of how I think about running this fund philosophically. Would love your take on this if there is room. And his question, AJ's question is having a differentiated view on the market with a timeline for when it plays out enough on its own to call it alpha, or does something else have to be true first? So look, it's a great question. In my opinion, I don't think it's enough to have a differentiated view on the market and a timeline, because that's just your variant perception. I think that you need to have a moat and a competitive advantage about your structure, your culture, your network, and your processes that create these variant perceptions. So, we did a study of macro investing once. By the way, Had I not done this study, I would not have met my partner, who is my biggest investor, which is interesting. It kind of shows you how we use learning as a strategy to make money, because I do these learning projects every year, and we go out and meet people, and it's unbelievable the people we meet that are potential investors that teach us stuff. In this case, I met my business partner, who's not only is my financial backer, but he's like a brother to me now with what I've learned from him. I'm constantly amazed at how smart this motherfucker is. I mean, it's unbelievable. And he is by far the brains of the operation. Okay. So when we did this macro study, what we found is that the best macro guys actually started out as equities guys and then eventually moved to having industry level insights. And then they started getting regulatory insights. And then they started getting economic insights on the whole national economy. And then they started really like, wait a second, this geopolitical dynamics can really impact businesses. So let's go and figure that stuff out too. And then as they were doing that, their network changed. So if you have equity insights, you're talking to management teams. But at the industry level, you might be talking to regulators. At the regulatory level, you might be talking to politicians. And then at the economic level, you need central bankers as your network. And then beyond that, you start talking to prime ministers, right? When you start scaling up your macro level contacts, right? So I would not advise to have a macro point of view unless you have macro level contacts of which you tested that point of view. And then the other thing, um, so the secret to the macro guys was not that they understood the macro investment world, right? So if you listen to like George Soros speak about a macro point of view, first of all, it's like indecipherable. But then even if you understand it 6 months or a year later, he was wrong. But yet the guy kept putting up numbers. Why? Well, the reason why is that he would have this point of view, and A, he was willing to change his mind on a dime. Okay. But B, that network and having the consensus point of view, and then speaking to all the other macro guys and the prop desks and the global trading desk and understanding where positioning was. So if the consensus point of view was X and positioning was X, well, the asset price was stable. But when the consensus point of view shifted to Y because of some macro event, George and the other guys that were really good at it knew that positioning needed to shift, and they would act really fast to shift their positions so that when the consensus, the positioning shifted from X to Y, the asset price moved and they benefited from that. By the way, there were, of course, times when it was an analytical point of view with the Bank of England, even though when you really studied that, there were a lot of other dynamics that people never talk about or understand, frankly. But most of the time, they had point of views. And then when the market started believing in a different point of view, they were willing to give up that point of view and go with that. So I would say you might have a differentiated point of view on the market now, but constantly do things within your structure, your culture, your processes, and your tools to be able to find new advantages that give you other variant perceptions. All right. And for that, you have to know the other players, I think. Who are the other players in your space, and so on and so forth. Okay. Next question. How do you average up? How do you average down? By the way, one of our findings is that averaging down, averaging up are personality driven. Talked about this before. I would be careful with, you need to kind of test out these things. Value investors tend to size up by averaging down before an event and as the stock is going down, right? Um, us, we don't like to average down. We like to size up after an event when a stock is going up and when fundamentals are getting better, right? Because, I don't, as a manager, I don't get paid for providing liquidity to other people. Um, by the way, this week, not going to say the stock because we own it. The company reports stocks only up 4%. The numbers were fucking phenomenal. And the management team is not getting on a call for an hour and a half. Okay. So our job during that 1 hour and a half in the aftermarket was deciding, hey, are we buying more of this thing? Because what are they going to say on the quarter? Okay. Where is positioning? So literally we scramble to determine. And then on the call, they gave guidance and the stock shot up from 4% to 9%. And the next day was up another 9%. Okay. So we were willing to size up after the event and as the stock was going up, when, by the way, the fundamentals are improved. But what needs to happen after that? Well, the analysts have to upgrade the stock. The mutual fund guys get in a huddle and they're going to be buying the stock. The hedge fund guys, too. By the way, this also happened after the overhang clearing event of the German kid with situational awareness, right? So where now people understood why these things were going down, now that event has cleared, people want to go back on offense. So there were all these dynamics that showed that if you bought it despite it being up, the odds of having a continuation effect were actually higher, right? So these are all the things you got to look at when you're averaging up. Druckenmiller has an amazing saying that we love. He says, "Get bigger as things get better." Like a lot of people want to get bigger, especially value guys, when the fundamentals are getting worse, the narrative is getting worse, the stock price is going down, and you're like, dude, like but wait, we're providing liquidity for people that are blowing out, but I'm good enough to know I'm going to average down into that. No, I'm not that good. No fucking way. Okay. Odds are, it's like, wait, things are getting worse. The narrative's getting worse. Stock price going down. There's more sellers. But it's cheaper. No, we don't make sizing decisions based on valuation. Valuation is neither a position sizing element, nor is it a timing element. Okay. What we want to do is size on other stock selection criteria. And that's where you should base your averaging down and your averaging up in. Okay. By the way, to be good at both skills, you can't averaging up or averaging down. You can't just depend on your analysis of the business. You have to have analyzed the stock as well. Stock analysis is, have you analyzed the holders and how they're going to behave if a thesis happens? The long only guys, the hedge funds, the retail guys, the short sellers. A bunch of guys are short. If this event happens, do they cover? If that event happens, do they cover? If this event happens, do they add to their shorts? Kind of anticipate what the behavior is going to be. The more you know them, the more you've done bear debates, the more you do that, the better your judgment becomes at figuring out what they're going to do or not. What are the basket guys going to do? What are the option traders going to do? What's the analytical community going to do? These are all things you kind of need to think about. And by the way, there are times when you thought about all of them and you're like, everything is telling me that there's only going to be a rush of buyers and no sellers in something if I buy it right here. And you get these short-term opportunities that can be very powerful. But to be able to know a great short-term opportunity, you have to know the psychology of the players, their skills, their institutional quirks, and their positioning, how they're positioned. Once you know that, you can identify great risk reward situations. All right. Two more questions, and then I'll go to the YouTube. Has your investing approach, by the way, this question was anonymous. Has your investing approach changed since HFT firms became more prevalent from a market structure perspective, especially considering the speed at which they price in new data and information? How do you expect the market behavior to change as new AI agents start trading? Yes, we have. All right. Step back. It's important to understand market structure. I've talked about this before, but I find no one gets it. But let me try again. You got to think about three market structures. Pre-2008 structure, so anything that's ever happened in capital markets before 2008, and understand what's happened there. Then you got to understand what happened in capital market post 2008. And then you got to understand post 2022 market structure when things changed again. Right? Now, one thing to understand is that before 2008, pods were smaller, ETFs were smaller, quant funds were smaller. Post 2008, pods are massive, ETFs are massive, quant funds are massive, and they're levered. Okay? Before 2008, commission dollars were much bigger. So Wall Street had a lot of money to throw at analytical departments. Today, that's smaller. Okay? Pre-2008, value investing really got known in the 90s. Today, everybody knows value investing. Right? Pre-2008, social media, the internet, smaller. Today, ubiquitous. And the narratives that come out of that are massive. Right? So if your strategy is a pre-08 construct, you're in trouble. Why? Well, because let me give you an example. So one of our jokes is that value investors have become liquidity providers to pods and quants. It's a joke, but it's actually true. Okay, so you're a value guy. Stock is at 60, you think it's worth 100. Okay, a bunch of quants and pods are along too. Stock starts going down, goes from 60 to 50. You're like, it's worth 100. So what are you doing? You're averaging down, you're buying more. What are the pods and the quants doing? Well, they're levered. So which means they're losing money. So they're blowing out. Like they're selling. Okay. And who are they selling to? You. That's actually averaging down because that's the discipline. You got to average down if it goes against you. Right. And now you're facing a mini drawdown and you're providing liquidity to these guys. But once these guys have stopped selling, do you think they start buying? No, odds are there are quants that are like, oh, there's a buyer. Let's see if we can sell them some more. Okay. Or other hedge funds have to delever themselves. They start selling. So you're averaging down again, but now quant funds are seeing you average down and they're testing you. They keep selling and they're selling short. So as the stock goes down, it's going down for the quants and the pods because it's going down. And you're the sucker, really, that's averaging down into that. Okay, fine. Now you've got a big position because the stock is cheaper. Okay. And it is, by the way, odds are. Your risk manager is up your ass now because they're like, dude, you're carrying a 10% position. When are we going to get out of this thing? When are you going to see a path to getting paid on the idea? Okay. Now, the stock's at 30. You think it's worth 100. It starts to go back up. What happens? Well, let's say you have a 10% position. It goes up 30%. You have a 13% position now. So what do? You're forced to sell. But the pods and the quants, as it starts going up, they can re-leverage back. So what are they doing? They're buying from you. So as you're selling, you're providing liquidity for them again, right? Averaging down and this market structure can be very dangerous. You better have the time horizon and the structural advantages, meaning that your capital's locked up, for example. But even then, very few people can withstand because you're averaging down at 10. The stock goes from 30 to 60. You might have a 20% position, assuming nothing else happens in your portfolio. Are you going to have a 20% position? Maybe. If you're running long short, I suggest you don't. Right? If you're running long only concentrated, by all means. But even then, having a massive position like that, these great ideas go through 50% drawdowns sometimes once every couple of years, if not once a year, right? So in many ways, value investors with a pre-2008 mental construct are not going to do well in a post-2022 market. So I think your strategy has to adapt to that, right? To deal with narratives, to deal with baskets, to deal with the pods, to deal with quant funds. These are all things you need ways of thinking and managing. Will the value principles still matter? The concept of value, which is buying a 50-cent dollar, margin of safety, Mrs. Market, moats and economic castles, opportunity costs, rule number one, rule number two, mental models. Of course, those things are always going to matter, but they need to adapt to the current market structure, right? I hope I'm not saying something obvious here because, I think I say this shit. It sounds obvious to me as I say it, but does it sound obvious? I don't know. Okay. But by the way, okay. Um, my friend Dan Loeb, he makes an incredible point. He says, I saw him make this point at a conference now. He says, he always tells his team that if you have an insight on a company, you need to tell me immediately. Okay. Don't go write it in a memo. Don't do a model. Call me and tell me the insight immediately. And the reason why Dan says is like, and pre 2008, if you had an insight on a company, it often took days, if not weeks, for other people to have the same insight. But today, with not only the abundance of capital that's out there, but with a number of smart people that are in the investment business, if you have an insight, odds are at the same time, there's 5 or 6 guys having that same insight, and then they're acting on the insight, and the stock price gets reflected immediately. And it can be 8 to 15% moves. Sometimes we've seen that happen, right? So it's a good point, and it's an adaptation to this market structure. Um, you know, I think that the AI, the post 2022 is when the fundamental guys are adding these AI tools. There's new things that are happening now, and you have to be aware of them. You have to be constantly testing them. I think AI um, has blind spots, and it's your competitive duty, well, actually your fiduciary duty, to find out what those blind spots are and try to exploit it, especially if you're going to use these weapons. You don't use a weapon until you know the weakness of the weapon. It's important. Okay. How do you know when it's time to admit you were wrong in investment? Do you define clear disconfirming signals before investing? Yes, we covered that. Or is it more of an ongoing judgment? How do you avoid letting ego get in the way of changing your mind? By the way, you have to know ahead of time how you might be wrong on an investment, and you have to make decisions on an ongoing basis when new information pops up. So it's both, right? Um, by the way, the other thing is one of the greatest blessings in our business is liquidity. I've always thought liquidity is the most beautiful thing I've ever seen. If you're wrong, you can get out. Nothing I love more than being wrong and not losing money. Okay, it's like, wait, I was wrong. Let's get out. The stock's flat, and you realize, wait, maybe we might be able to go short because no one else has realized what we realize. It's rare when it happens, but it's beautiful. If you're right, you can buy more. One of the things with private equity guys is very rarely can they buy more of something as it's working. It's rare. They can do it, but it's rare. The Chris Sacca has a great concept. Uh, he calls it put more wood behind the arrow, meaning you spray and pray to a bunch of companies. But when a company starts working, try to invest more, because I like investing more when a situation has been de-risked and very what Chris does, he does that with privates where it goes from Series A to Series B, but the business has gotten better. There's proof of concept now. It's almost not even a venture anymore. It's like growth equity. Phenomenal time, and you want to be able to see that. But that's on the upside. You want to be able to get out as things go down. Um, so it's not about being right or wrong in our business, by the way. It's about making money. And let me share a book with you guys that kind of describes the process that I'm about to go through. It's a very powerful book called The Art of the Long View by Peter Schwartz. Now, I know some practitioners or theoretical investment guys that hate this book, but I happen to think it's very powerful. And so, what this book is, it gives you the process on how to have a judgment on something that's about to happen and track it. And the main crux of the process is to have three scenarios that you think that could happen. In this case, we like the bull case, the base case, and the bear case. By the way, we tend to like five scenarios. And the way that we size them initially is 5%, 20%, 50%, 20%, 5%. So 5% for the case above the bull case, which we call the bonanza branch, where your scenario tree, you have this branch on the tree, it's a bonanza. This is going to be a 40 bagger. Here's why it happens, but there's only a 5% chance of it happening. Below that, you size it at 20%. That's your bull case. My bull case is it's going to do X growth at this margin, at this ROIC, and this is why it's worth a three bagger. My base case, stock doubles. This is why it's going to do it at this growth, margin, ROIC, uh, 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 and such. And then your bear case, this is why I think it's going to go down. And then your disaster case. Okay. Um, okay. Once you determine what these things are, you need to imagine what these signposts are that are either going to confirm or disconfirm each case. And then you set up a process to track these signposts. Okay? And the signposts have to be something you can quantify, something that is behavioral, and usually an insight of some sort, right? Something that is, you develop an insight. So, for example, for Amazon, it might be, I was expecting AWS to grow 35. They're growing 43. Okay. Well, that's bullish, right? Something like that. But it's something that you decide ahead of time. Think of a signpost are you're driving from New York to Miami. Well, if you see signs for Georgia, yeah, you might be on the right path. What if you start seeing signs for Minnesota? Well, dude, you might be in trouble, right? You're going the wrong way, right? So setting up these signposts And the way you set up these signposts, by the way, you need to do field work. Ask people, what do you think if this scenario happens? What will we see? And the guy will be like, look, if you think they're going to get this number of sales, these 4 customers, they need to get them. They're going to have to get them. And then literally 2 weeks later, you're reading a trade magazine, and you hear customer number 2 on that list is going to the company. You're like, wait a second, that's a signpost, right? You got to do your analysis, right? What are the numbers that drive each of the cases? You got to do premortems. Okay, a premortem is you say, 5 years from now, we've lost money on this investment. You do it as a team. Here's why we lost money on it. Okay, what are the signposts that we would need to see year 5, year 4, year 3, year 2, year 1 to know that we're about to mess up? And then you track those. The pre-parade, we learned that process from this incredible book uh, um, that if you haven't read, you got to read, by Sebastian. Oh, no, sorry. Wrong book by Sebastian. The Power Law, which is a book on the venture capital industry. But the reason why you have to read it is there's a history of the crossover funds in there. So you get the full history of how Tiger Global started doing crossover investing and how powerful it was. But in the book, he tells you about the pre-parade process, where he says there's not, the venture guys figured out that there's not enough thought of, hey, what if instead of a pre-mortem 5 years from now, this is a parade because we've made so much money on it. What would we need to see if that scenario happens? And they start tracking the positive scenarios for that too. So I think that you got to know you're right or wrong on an investment before the earnings release comes out. Okay? Because if you're waiting for the earnings release, in many ways, earnings risk is gambling. You have zero control of what's going to happen on earnings, in my opinion. By the way, there are guys that we know are very good at it. I think over time we've gotten better at knowing that, hey, business is good and this thing is inflecting and we're going to be okay. But we're still shocked, that when it's like, wait, stock's down 20% because of this. It's like let's wait, and then the second starts to go back up, we average up again. So really, earnings can be a crapshoot, and you need to decide ahead of earnings when it's actually happening. Okay, so read this book. It's very powerful. I have my copy somewhere. Um, uh, One of my buddies I collaborated with on ideas is always stealing my books. And I go to his house, and all my books are there. So I have another library at his house right now, and that's probably where my copy is. Um, okay. All right, 2 more questions. Starting from scratch as an analyst, what advice would you give for building a network of industry experts, management teams, and investors that can help with idea generation and field research? Start with an idea, okay, and then build a network around that, and then cultivate that network, okay? So, um, you can email IR, by the way. They won't give you a meeting. Write your questions down, email them. If the questions are good, somebody will answer them at the company. That's the start of how you start building your network. Thoughtful questions to IR. By the way, it's not unusual for IR over years to develop into another role. So the IR guy sometimes gets a management role. Even I've seen IR guys become CEOs sometimes. So start with the IR guys, write thoughtful questions that shows that you've done the work, and send it to them and ask them the questions. And then with management teams. By the way, you also have to learn how to cold approach to build a network, or to use LinkedIn. One thing I suggest, especially for younger people, is you either go through your parents if you have to, you go through people that you know in common. Can you introduce me to him? I want to talk to him about this. Find who these people are in your life. And then last, always make sure you know how to leverage the alumni database of the school that you went to. That's actually a really good tool for AI. If you take the alumni database and you put it on LinkedIn and you put it on, let's say, Gemini, and ask it to find all of the LinkedIn profiles and then to determine by industry where they are, it's actually pretty good at that. Um, and then write a message on LinkedIn to these people. You'll fail out of 10 times, 6 or 7 times. But the 1 or 2 times that it works, fantastic. So you got to do that. Um, don't ignore the private companies in the space, the venture capital guys, the private equity guys. Very often, they're very knowledgeable about the industry where the public companies are operating. And by the way, the private to public arbitrage is a real thing. It's a big competitive advantage. Um, but you have to know and be very knowledgeable about the ideas, about the points of tension and the arguments, because if you're just don't know anything, you're asking questions, the questions are going to seem like you're half-assing it, or worse, you're going to seem like you're not adding value. So do your work first and then reach out. Nothing is more impressive than when a young guy knows the management team, meaning doesn't need to know them personally, but he knows them, knows the dynamic and the issues, and he's talking to somebody knowledgeable, and you're like, wow, this guy's asking really good questions. That's how you really do develop a network and your street cred goes up. All right, last question before we hit the thing. Okay, we've been going on for 3 hours now. What's your risk assessment process? Okay. First, you know how a pilot has a checklist of risk stuff he has to check and to check off? You need one too for investing. And it's got to have your risks on it. Start with business risks, stock risks, risks that have to do with your firm that you work for, and risks that has to do with your insecurities, weakness, foibles, negative patterns, and shit that you know you're an idiot on, that you're trying to minimize that happening. Right? For the business, competition risk, regulatory risk, customer concentration risk, key man risk, sector risk, platform risk, disruption risk, structural integrity risks. By the way, do you read the risk sections of the 10K? That's where the lawyers go and protect the ass of the management teams on. You got to read that. Pay attention when there's a new one that's added. There are AIs that do that just highlight it for you. Pay attention to that. For the stock, earnings risk. How does this thing move on earnings? Gap risks. When it's gapped down, why does that tend to be? Crowdedness, factor risk, short interest. These are all things that you gotta figure out and assess. For yourself, what biases are you prone to? Is it confirmation bias? Are you anchoring to something? You did a Bobert debate with somebody, and you were really emotional when he said this. Why were you emotional about it? By the way, it's the job of both your PM and of yourself to pick up on that. Okay? Is the idea in your power zone? We call that power zone risk. Okay? Meaning, it's like my buddy that does retail stocks, but yet he's 0 for 0 on retail. By the way, there's a famous investor. He doesn't like to be named, but he has his analyst that loves to do retail stocks. And sorry, let me stop sharing this because it's no longer relevant. He likes to do retail stocks. And the analyst realizes that he's 0 for 0 on retail. Okay, that every time he's in a retail stock, he's like literally lost money. Okay, so he goes to his PM, to this famous investor, and he's like, I'm just gonna stop doing retail. Okay, like I'm literally a disaster on it. And the famous PM goes, no, you have to keep doing retail. And the analyst is like, but I suck. And then the PM goes, but why deprive the rest of us? Being 100% wrong is as good as being 100% right. All I have to do is short it every time you pitch me a long retail. And the guy tells the story is like my face dropped because I realize I'm his contra. um, but anyways, so is this within your power zone? All right, like me, for example, I'm not allowed to look at a turnaround. Okay. I'm a turnaroundaholic. You pitch me a turnaround, I'm excited. It's like sex for me. I want to study it, think about how we're going to turn around this business. I'm thinking about the CEOs going through the dude. Like I'm like 0 for 0 on turnarounds. Okay. They always take longer than you think. Okay. There's always a bigger hole in the balance sheet. There's always a bigger, I mean, it's like I'm a disaster. What I do now, though, is I wait for the business to have turned around. I often miss the first 50% or 100% even, and then we buy it right after that. Okay. So I know that about myself. I know my power zone. So these are all things. And then and your risk section for your firm. What does your firm, what's your firm's moat? Is the idea in your firm's moat? What's what kind of capital does your firm have? Does it have quarterly capital? Well, your ideas depend on it working 3 years from now. Well, you're going to go through some problems. Maybe you shouldn't suggest that it's a 7% position. It should be maybe it's smaller, right? Does the idea reflect the PM's strengths, weaknesses, and idiosyncrasies or not? If not, it's a risk, trust me. And he'll never have the conviction to defend it, right? Does the idea fit your PM's tools and weapons and even his network? Does he know how to cross-reference the idea? Have you helped him cross-reference? These are all things that you got to think about in your risk assessment process. Last, I would add to, you know, your idea also has to fit your principles. So we have a principle, we call it Kaufman optimal. So my mentor, Peter Kaufman, when an idea is Kaufman optimal, it means that the idea is simple but unrecognized. Because he loves this saying that people that have amazing results are the ones that exploit unrecognized simplicity versus the ones that try to exploit intricate complexity. So when an idea comes in and it's intricately complex, no interest. It's not Kaufman optimal, right? Then there's game theory optimal. Okay. Meaning the idea not only fits our principle for analysis, but we understand the game theory moves you have to do to make it optimal. And that involves the behavioral work, it involves having the right structure, be able to use that structure against an opponent and stuff like that. Okay. I think we covered a whole bunch of stuff. My God, there's still 8 people here. Uh, my friend Roman is on. Roman, I love you and I miss you. Okay, bro, this is Hormozy level live stream length. I love Hormozy, by the way. We're big admirers of his. Okay, Sam Putman, do you believe Gavin Baker is a seer? I'm a big admirer of Gavin Baker's. Smart fellow. I always listen to what his stuff that he says. All right. What are the best, Max asks, what are the best red flags you love to see when you're looking to short stocks? We love the behavioral stuff. Um, insider sales, always great. A CEO that all of a sudden starts spending more money on his personal life, always a red flag. Um, uh, when a CEO that runs a public company just made a bunch of money and he starts spending money on art collections, yachts, cars, and the whole thing, always a red flag. Pay attention. If you see that happening and the fundamentals start flattening out or going down, time to short the stock. Okay. Um, the ones that I mentioned, overvaluation together, changes in accounting, a bad auditor, negative fundamentals, time to short. These are all flags we look for. There are others, there you have your contra indicators. For example, there are people that all of a sudden, like in I'm at this gym working out in mid-June, and these trainers are talking about making money in memory stocks. Like literally, alarm bells we're like, whoa. And then I get trained by one of the hottest women in the world, and she's telling me like by all of this money she's made in memory stocks, and I'm like, Mar, you got to get out of this stuff. And then these things go up another 10%. And she's like, complete. You told me to sell. They're still going up. I'm like, yeah, it's okay. You like it. And then as they're going down, she's like, how did you know? I'm like, I didn't know anything. But I know that maybe it's a red flag behaviorally if a bunch of guys that are trainers are making money in memory stocks when they wouldn't know DRAM from anything else, right? So there are these signs that you need to have as people that are getting long that really are should not. Those are some of the things that we look for. But as usual, it's a combination of things. By the way, um, customer concentration risk. We love when we're short something and we're able to handicap when the customer is going to blow out. Can you touch on investment banking, public equities, and how to shift an investor to investor perspective? You need training for that. And also, you need the appetite. The guys that we know that are good at investment banking that want to go into public equities usually can't shut the fuck up about investing in stocks while they're at investment banking. And they can't wait to go to the buy side. The ones that want to go to buy side because it's a fashionable thing, you kind of know. They're not the guys that are stock jockeys and talking stocks on weekends, going to idea dinners and investing in whenever they can. I know a guy in investment banking where he couldn't buy single stocks, but he had figured out a strategy to make money from ETFs and arbing out all ETFs. I'm like, yeah, that guy's going to make it when he moves over. And by the way, that was 4 years ago. He's one of the best analysts I've ever met. So you kind of know, you got to love the game. Tycoon says, personal leagues, leaks, I think thinking about the problem around moats is people think they provide an easy way out. You have to predict moats in businesses, not identify current ones. We agree. My second question, as a manager that gets to pick his mandate, why would one pick to be a manager in crowded, efficient US equities instead of more inefficient markets or products? Who says US equities are efficient? Because something is crowded and everybody's in it doesn't mean it doesn't make it efficient. On the contrary, today and large caps exist some of the biggest inefficiencies. We had Microsoft this week move up close to 22%. That's close to $700 billion of move. And a large cap. Who says that US stocks are efficient? I'd argue that with the rise of pods, the rise of quants, the rise of ETF, the rise of leverage, the rise of AI tools, that it's made stocks more inefficient. Cliff Hasness has an amazing quote. He says, if there is something to turn the wisdom of crowds into the madness of mobs, it's social media. We actually believe he's right. To assume that markets are more inefficient today, I think it's a wrong assumption. Excuse me. To assume that US markets are more efficient today is the wrong assumption. Also, why do you want to go to a market that no one knows? And you might toil away for years and no one realizes it. And then one day, somebody realizes it, you sell up 100% when you should be buying it, usually when it starts doing well, right? Just because something is unknown doesn't make it good. You know, it's the see the this is the common thinking that markets and the US are efficient is a pre 2008 way of thinking. Because pre 2008, it was probably true. You know, post 2008, I think it's more inefficient, actually. But that's my opinion. I could be wrong. Uh, um, so, um, anyways, add to rogue stack away from my AI system. Hold on, let's start here. You gave a talk. So, Built on Bitcoin says you gave a talk where you said your core three values are dominance, vulnerability, and generosity. Can you say more on why you chose those especially they seem counterintuitive? So, it's interesting. I hope Roman is still watching this because in many ways, Roman Corell, who's a friend of mine, taught me a lot about all three of these things. He taught me how to be dominant. He taught me how to be generous. And he taught me how to be vulnerable. Roman um, isn't a go-getter. He's a go-giver. You know, um, he's the kind of person that he gets into a situation, he just starts giving. I'll tell that story. It wasn't me that came up with these three. It was my grandfather. I asked him once, what are the three most important value of a man? And he said, that's easy: dominance, vulnerability, and generosity. And by the way, it's values of women, because if you meet the women in my family, they're highly dominant, they're highly vulnerable, they're highly generous. And dominance doesn't mean domineering. It means that you're dominant. You know what you want. You know how to go after it. You're also a father. You're also the mother. You're also the protector. You're also the provider. You're dominant. You protect your own. You don't let people fuck with your own. You're papa, mama, protector, provider, right? You also have to be vulnerable, meaning you have to be generous. You have your time, you give it. You have money, you give it. You help people out. You give people what you know. You express generosity. If you go in the field and you're meeting with a management team, you never let the management team pay, ever. So you take a mentor out for coffee, you pay for the coffee. You have to be generous in life. Whatever you have, you give it. Okay. And then you have to be vulnerable. Vulnerability is a path to strength. Vulnerability is not knowing the answer and asking the dumb question. Vulnerability is romantically telling your girl you like her. Vulnerability is telling your friend that you love him. You're vulnerable. You're putting yourself out there. Now, vulnerability doesn't mean you're sad and you're crying all the time, because that's your fucking waste of time if that's happening. You're just a victim. Okay. Generous doesn't mean that you're giving to people that are taking advantage of you. And being dominant doesn't mean you're domineering, but you have to be all three at the same time. You have to be dominant, you have to be vulnerable, and you have to be generous. And I think my friend Roman, after my grandfather told me this, is when I met Roman. I was like, wow, this guy is literally a living impersonation of those three values. He's highly dominant, he's highly vulnerable, he's highly generous. And I think it almost knowing that it was possible to be these three things. My grandfather was them. I think my grandfather got into more trouble than most because of these three values. For me, it was like, wow, and it's something I've tried to express, and I still work at it actually, and it's not easy. Um, but anyways, second question, you say, how do you think about the importance of clearly define your values? Seems related to the point that 80% of problem solver, 20% are goal setters from Evan. Very true. Um, uh, Look, you have to know your values and what you want because to know how to act. And also to set your culture. Your internal culture in your mind is designed around the values you have and the habits that shows that those values are important. So if I'm a learner, that's my value to learn. I need to teach because the habit of teaching is how you really learn, right? It's very powerful. Teachers are really the ones doing all the learning, right? So if I go into a firm and they say, hey, learning and training are very important to us, it's part of our culture. Okay, that's interesting. Show me the habits and the weekly cadence of meetings that show that you're learning and training. Odds are they don't have it. Culture is the is values being put into motion in rituals, consistent, persistent meetings. And then what emanates from that is your culture, right? So our cultures in business are so we have three personal values, at least for me. Other people can have whatever their values are. Dominance, vulnerability, and generosity for me. But in business, it's collaboration, introspection, and constant improvement. I want to collaborate with smart people. That's very important to me. I want to learn and be introspective and learn from my fuck ups and my wins. And I want to get better every day. And I want to do it fast. So that's how we think about values. If you look at writing, if you look at content strategy, you're collaborating, you're being vulnerable because you're putting your ideas out there. Odds are somebody's gonna be like, dude, you're a fucking idiot. Right. So in a way, content strategy is me living my values of vulnerability, generosity, dominance. I'm teaching, I'm helping, hopefully, and then collaborating, being introspective when I'm designing the content, and then also hopefully improving, right? Okay, I can see how reading broadly can help as a risk taker or long-term direction of the macro point of view, but in a world driven by fast quant traders, you think it can help build short-term horizon edge? Yes, especially if you know those four things I told you about. If you know the players of a market and you know their positioning, you know their psychology, you know their skills and what they're good at, and you know their institutional behavior. Like, for example, most mutual funds are ending their fiscal year in October, November. Institutionally, they have to. So, what is their positioning going to be? What are their skills, and what's their psychology around that time? Well, if you know that, that can yield you to some short-term tactics. Short-term tactics are all about knowing the players. Know the players. There's three ways you can make money in the markets. You can know the idea, you can know the environment of the idea, you can know the players. All three. When you have an idea with all three of them, that's when you have the great short-term and long-term opportunities. One IG says, thank you for answering the questions. I had to go rogue and step away from my AI system in 29 because it was just too slow. I saw things happening and I need to take action. Okay, I get it. My second question, as a manager that gets to pick his mandate, oh, I think I covered that. Okay, so I covered this. Sam Putman says, the problem is there's not allowed to trade, but while there's no IB, they never actually learn. What bottlenecks need to be solved in order for Google's smart glasses to get massive scale? Max, it's distribution. Um, so Google has done an agreement with Warby Parker. And it's interesting to track what's about to happen there for a lot of reasons. We track it because I like Warby Parker as a business. I can't say if we're involved or not. We're not allowed to talk about our positions. But Warby, I think it has an interesting product. I like the fragmented space that it's in. They're pretty good at social media and SEO. And we like this agreement that they have with the Google. So it's interesting. All right. Sam says, do you think Bill Belichick told Jordan he liked her? I'm not getting it. Okay, fine. Um, I has Bill Belichick met Jordan? I know Tom Brady has met Jordan many times. Um, by the way, uh, people haven't read Bill Belichick's book. Okay, um, that's pretty remarkable to me. Um, so Bill Belichick wrote a book called The Art of Winning, and people haven't read that. What the fuck? Okay, it's like you know, maybe people should read this. Okay, Michael Hawley's book has the same number. I've read Michael Hawley's book, by the way. I don't think there's a thing about the Patriots that I don't know. Uh, uh, but no one's read this book. Okay, it's unbelievable to me. Okay, I mean I've read so many books on American football. It's kind of shocking. It's one of the most strategic games that we've ever seen. Um, but anyways, lasted 3.5 hours. Um, sorry, there's one last question. After making money, how do you retain interest and curiosity in life? How do you prevent burnout and learn to relax? How do you retain the cognitive bandwidth for voracious reading after work? Okay, so let's start with that because I think this is very value added. Let's stop sharing because I'm double sharing here. Um, okay, preventing burnout. It's funny, Roman, I don't know if he's still on, but uh, my friend Roman also taught me something about quality of life. He says that, you know, the average European guy has a better quality of life than some of the wealthiest Americans that's ever lived. Literally. Because, there is such a thing as quality of life. I mean, don't get me wrong, I'm as piratical and capitalistic as they come, but you have to learn how to relax. You know, Whenever people focus on working out, like that's exercise. But what do you do for recovery? How do you recover? Like do you have recovery activities? So for example, um, I get a weekly acupuncture and acupressure session. Every 2 weeks, I work out with a pliability coach that was literally Tom Brady's coach. Every morning, I wake up, I take a Theragun, and I give myself an entire massage. Before a workout, I use bands for stretching. I take a nap every day for 20 minutes, every day. And then on the weekend, if I have time, like I literally will nap for 2, 3 hours if I have the time and my kid is not climbing all over me. Okay. It's very important to know how to recover from stress in our business because the stress literally will kick your ass. Okay. And it affects your health. It affects you in ways that you don't really understand. And that's one of the reasons why guys burn out in our space. So you have to know. The second is you have to read in our business. Every day, I make it a point to read 25 pages or more. The stuff I'm reading about right now is a learning project. We haven't disclosed what it is yet, but it's literally every day. And then for 2 hours, once a week, I have two consultants that are working with me on the learning project, and we go through that as well. Okay. They're reading stuff. We're making lists of stuff to watch. We're often watching stuff together. Often walking. For example, it's when we were studying Tom Brady that we figured out that Brady gets massages in the morning. And I turned to my two learning partners and I'm like, hey, don't people usually get massages in the afternoon or evening? What's the timing difference between doing in the morning or doing in the evening? Game changer, especially a risk taker. You want to get massage in the morning, right? But we got that from reading and from doing a learning project. You have to do it for your own research and development. Uh, um, then you have to know how to leave the negative chemicals at work. Okay. You have a bad day in the markets before you go home. Don't bring that shit home. Go to the gym, get on a treadmill or a salt bike, and for 20 minutes, try to get to 80% of your max heart rate and flush those negative chemicals out. That's how you reset your emotional system. I'm talking a big game this week. I didn't do that, and Thursday, Friday were rough for me. Right? I caught up this morning. I'm catching up tomorrow, but you need to sweat that shit out. Okay. Same with positive chemicals, by the way. If you've been having a run, okay, you're getting kind of cocky, you're getting pro-cyclical in your behavior, time to get into the gym, get your ass kicked, sweat out those chemicals too, because that festers as well. And then, we've made decent money, but we haven't made the kind of money that we still want to make. I want to make my guys rich, but I still retain curiosity in life. Got to meet new people. Got to have friends that are also meeting new people. Got to have friends like my buddy Roman that was just on, where he's Roman and I used to take these trips every year where we go snowboarding together. We went to Kenya together, had this unbelievable trip there. We met new people. It was there that I met one of my mentors, Lipo Mulhausen, who taught me more about vulnerability than anybody else. It was also there that I ended up meeting an ex-girlfriend. You got to do stuff like that, compound activities in life, meeting new people, learning new things, and never lose that. I think it's important. Sam says, um, oh, by the way, Alman, you said, how do you retain interest in money when you're aware of the diminishing marginal utility of the dollar? I mean, it's at this point, you don't make the money because of the marginal utility. You make the money because it's a way to keep score in its competition. You got to enjoy competing. Step back. You know, you got to know how to use your moat on offense. You know, you got to know it's you think Jeff Bezos is in it for the dollar at this point, or is he in it because he wants to just compete? It's fun to compete. It's you gotta have that ambitious energy to compete and win. If you don't have it, it's okay. It's fine. The there's no there's I don't judge people on that. But in our business, by the way, the other thing about making even more money is I want to get my guys rich. If somebody comes to work for me, I want to see him do well. So at this point, it's not only me getting rich, but it's also getting my guys rich. So I think it's um, don't worry about the marginal utility. Uh, 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 said Batman. Throw in a foundation if you feel guilty. Hey, let's not be wise guys here, Mr. Sam. All right, Sam says I binged TBPN and All in All Day. Love both shows. By the way, People like to shit talk all in. Show me another show where four billionaires, because I'm pretty sure even Jake Kyle's a billionaire by now. Okay. Uh, and Sachs and Chamath and Friedberg all get on a show and throw out their opinions. Who cares what they think about politically? These guys, if you track what they've said, have called out major heaters when it comes to themes and investments. And yet people should talk these guys. Say what you want about Chamath, but he's not afraid of being who he is. And the guy incinerated money and came back from that. Do you know how hard that is to do? Whether you trust him or not, whether you like him or not, shouldn't matter. But if the guy says something, maybe you should listen. The TVPN guys, they're phenomenal, phenomenal, great podcasts to listen to. Uh, uh, so I think they're great. They're great. All right, I'm gonna be late for dinner in 20 minutes. Hope you guys learned something from this. We'll do it again in a month. Um, hold on. Alman said, "Did you ever read Bertrand Russell?" I have. So Buffett used to recommend people read Bertrand Russell in the old days. He says, "I think we are inherently competitive, but I wonder if the struggle for constant status is what stops true actualization." It's true. Um, but I don't do it for the status. I mean, don't get me wrong. I'm a human chimpanzee. Status is important to me, right? Um, but if you do it for the status, it can cause you to make all sorts of cognitive, strategic, and tactical mistakes. Okay. So be very careful playing status games. And by the way, one of the emotions that we've added, because there's 10 emotions that we used to say there's 7 emotions, that we added an eighth and a ninth and a 10th. But one of the recent ones that we've added, and it's a modern one, by the way, is status, where on social media, Instagram is very status oriented, for example, and people are willing to spend a lot of time on it because of the status. You have to be very careful with status games. Um, they can be very dangerous. Okay. One last thing. Um, July was rough. You're going to see a lot of drawdowns, we believe, in July in the investment business across the board almost. Um, I know maybe of a couple funds that are up right now. One of them is a dear friend of mine that degrossed in early July. Um, um, but guess what? These degrossing are going to keep happening. And it's important to learn the seasonality of the degrossings and the seasonality of the regrossings. And there is a certain seasonality to them. And it's also important to understand competitive degrossing, right? So meaning if the entire hedge fund industry is high gross, high net, high concentration, full blown Momo, full blown uh, uh, concentration, maybe it's time to lighten up your gross, lower your net a little bit. Be careful of your Momo names and all that stuff, right? To think about competitive degrossing and competitive regrossing is, I think, becoming more and more important. Um, we're aware of them. I wouldn't say we're the best at it. We know people that are way better than we are at it. But I think it's important to think about as a business. I suggest also you guys all read Seb's new book on AI. It's the unfinished and infinity machine, which is a story of Demis Hassabis. My best friend and I hosted a dinner for Sebastian. Um, and we were able to ask him questions. I also did a Zoom interview for a bunch of students with him, but we decided not to publish that. This was a phenomenal book, and if you haven't read his More Money Than God, uh, which is the definitive history of the hedge fund business, excuse me, it's an incredible book, and very well researched. And what you have to read, by the way, is the notes. The notes are as valuable as the rest of the book. Anyways, all right, I really got to go now. Thanks for listening in, guys, and see you next month.